roll call and to establish a quorum.
Good morning, everyone. Governor Lujan Grisham. Commissioner Garcia Richard.
I'm here.
Secretary Romero.
Present.
Treasurer Eichenberg.
Present.
Mr. Jennings.
Here, present.
Mr. Lavender.
I'm here.
Mr. Rawson.
Present.
Mr. Messina. Mr. Tejas. Ms. Allen.
Yeah, I'm here.
Mr. Bingaman.
Present.
Madam Chair, we have a quorum.
Great, thank you so much, Andy. Do we have a motion for approval of today's August agenda?
Cheryl, so moved.
Okay, we've got a motion
Second.
by Member Lavender, second by
Lee.
Okay, we've got a second by Member Rawson and Member Jennings, maybe?
That'd be fine, whatever you want to do.
All right. And if we, do you have any discussion on a motion to approve the agenda? Andy, could we get a roll call vote on motion to approve?
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Jennings.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina, has he joined the call? Have you joined the call?
Yes.
How about Mr. And you vote in the affirmative?
On the change?
Okay. On the agenda? Okay. Mr. Tejas.
Yes.
Is Mr. Tejas? Okay. Ms. Allen.
I'm here. Yes. Vote for it.
Mr. Bingaman.
Yes.
Madam Chair, the motion unanimously passes.
All right, great. Thank you, Andy. Next, we'll move to approval of our June minutes since we were in recess during July. Our last meeting was in June. If members have had a chance to review those minutes, I'm looking for a motion to approve.
And Cheryl, that move we approve.
Okay, Member Lavender, is there a second?
I'll second.
All right, we've got a motion by Member Lavender to approve our June minutes, a second by Member Messina. If Andy could take a roll call vote, please.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Jennings.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion unanimously passes.
Great, thank you so much. With that, we'll move to agenda item 2A. And Steve, before you start, I just need to let you know, I'm probably going to have to hop off around 11, maybe even 11:30. So maybe if I could pass it off to someone else to chair at that time.
Thank you, Commissioner, of course.
Okay.
And I will remind everyone to please go to mute if you are not already there. Thank you and good morning. Please take a look at page 14, which is the SIO briefing, and I'll also be referring you to pages 15 and 16. As usual, let's begin with a recap of what's happening in the energy world, the traditional energy world, both in the U.S. and in New Mexico. Before we do that, the July 2022 total distributions from the funds for the last 12 months have been $1,165,218,000. The contribution from the state land office is remarkable, continues to be so. The July number is $251,692,000. That is 90 days lagged. And Commissioner, if you have any comments, please make those.
Yeah, Steve, not necessarily. You know, we are starting to see prices head back down. So I think we're kind of wrapping up the last few months of our record.
Well, it's been a nice ride. The net asset value for the funds as of Friday was $38,467,546,000. That includes $1.5 billion we received to go to the Early Childhood Education and Care Fund, a very substantial contribution to that fund. Turning now to oil prices. WTI as of Friday was at $90.77 per barrel. New Mexico Intermediate was $87.32. WTI was at $68.56 a year ago compared to the $90.77. And New Mexico was at $66.46 per barrel compared to the $87.32 as of Friday. U.S. rig count, 762 as of Friday. That was 503 a year ago. In New Mexico, 106 rigs as of Friday, 79 a year ago. Natural gas is remarkable, as is oil. U.S. natural gas price as of August 16, $9.28 per MCF. A year ago, that was $3.93. So up from $3.93 to $9.28. On Monday, U.S. futures for delivery in November, December, and January were each over $10. Prices haven't been that high since 2008. So remarkable things happening in that world. Any comments or questions before I move on?
Just remember that I think 40% of our income comes from stripper wells. I think that's a good number, and that's when we do away with all the stripper wells and some of the things that we put on those requirements, like you can your 40 or you can make $200,000 gross income. It's not net to be qualified as a small producer, and it really has hampered the ability of people to stay there and work in the oil fields on those marginal wells. I mean, it's something that we need to change and give them a fair shake at it. $200,000 with high costs like that, it doesn't make sense. But 40% of our income, look at it. So, thank you.
Thanks for that comment, Tim. If I could get you to move down on the SIO briefing to item number 5, please, the investment performance. Vince is going to give you some more current numbers, as will RVK, so I will leave that to the two of them. Under item C, council matters. Under new business, item 5A1, you, the council, will be able to discuss how you would like to meet in the future. A couple of people have said they'd like to come back in person. A few people have said they're more concerned and would prefer not to. It's possible that we may propose a hybrid structure with some in person and some remote. And I think that would be beneficial to lots of individuals, including our consultants and the managers who present, and they would not be required to New Mexico, but that is up to you, and we'll go through that under new business.
Okay, Steve, just in case I'm not here for that discussion, and I did convey this through Sunile, I think to Charlie, you know, my big concern is having meaningful public comment. And so you know, if we do go back in person, I hope that we will allow folks to give public comment in person again, rather than just reading the written comments.
Thanks, Commissioner. I met yesterday with Brent and our IT staff, and I think we have come up with a way to do that would be agreeable, even if we decide to go hybrid. So if you are not on the call for that discussion, I'll give you a call and we'll go through that after the meeting if that's acceptable.
Thank you.
Item C2. We need to add at least one council member to our investment committee. So if any of you are interested, please get in touch with Harold, our chair, advise him of your interest, and he will bring that to the council next month, and we will get you appointed, and we would appreciate having you with us. Item D, operations. Item 1 under D, we have 2 new people on staff. Dawn Iglesias has joined us. And Vince, if you would at this point, please introduce Dawn.
Sure, Steve. Good morning, everyone. So we are absolutely pleased to add Dawn to our investment strategist, one of our investment strategist spots. And I'm going to discuss that with you a little bit in my briefing section, but Dawn is extremely well qualified for that role, and we're just so pleased to have her come over. She's worked with the legislature for a great number of years, and so knows us well, knows the state well, knows legislature and so forth. So we couldn't be more pleased to have someone like her join our investment staff. So I know Dawn's on the line. Dawn, do you want to address the council?
Absolutely. Thank you, everyone. It's a pleasure to be here. I'm so happy to be on board, and I look forward to working with you all.
We are thrilled to have you, Dawn. Dawn followed us for the LSC for years. I worked with her in depth on several things, as did Vince and Charlie and others. She's just as sharp as she can be, and we are thrilled that she has joined the staff. Brandon has
I tried to get Dawn over to the land office with me. So whatever it was that you did, I mean, congratulations to you. She's amazing.
I couldn't agree more, Commissioner. We're so pleased she chose us. And if she has a sister or a brother, maybe they could come your way. We also have hired an analyst for the accounting department. She will not be starting for a few days yet, but Brent, would you comment on that, please?
Sure. We've been looking to fill this position for probably over a year and a half. We did finally find someone. She'll be starting in 2 weeks. Her name is Norma Para, and we're so excited to have her. She has about 20 years experience, including about 5 years working with Kellogg's in Mexico. She has roots in Mexico, but she's been in the States for some time, and we're just so excited to have someone to add to our accounting department, and really positive about her starting in the future.
So I think it's really true that good things come to those who wait, and we have been waiting for both Dawn and Norma. We didn't know quite who it might be, but we're happy that they're the ones that are joining us. We're still looking for an analyst for our real estate and real return portfolio, and another analyst for our fixed income portfolio. Vince, how are we doing on those two?
Pretty well on the fixed income side, Steve. We had several good candidates come in the last few weeks. We held 4 interviews last week, and Tom and I are still discussing. But I'm hoping we'll be able to move on someone there in the near term. Still struggling a little bit with the real estate real return side. We're having people apply, but no one's really hit the level that we really hold out for. But we're hopeful there. We've got one more spot to another strategist. We're going to hold off on that one until we get these 2 asset class analysts in place.
Vince, you were, I'm sure, going to comment on this a little bit later, but let's do it now, if you would. David Lee is going to be retiring, and Vince, if you would comment on that and on who will be moving into his role, please.
Yeah, so we're always disappointed when we lose somebody to retirement, but out of the 4 ways that we lose people, that's the most acceptable. We're always so glad that they've put in the career that they have and are able to retire. David has been here, I think, for 24 years, and he's on the line. I'll let him speak here in a second, but has just had such an excellent career in public fund space. 24 years or so with here at the SIC, and several years before that with the Pennsylvania ERS as an analyst for them. So, and Dave's had several roles here. He was a portfolio manager, picking stocks for quite some time. He was a strategist for me for several years, and then him best as his asset class director role for private equity. Just one comment there. We get several types of reporting in terms of performance. One report we get is real good on the asset class level, better than just the other reports that we get. And the performance of the private equity program relative to other private equity programs at public funds in the state is just in the country is just off the charts. We're way into the top quartile against other public funds with our private equity returns, and Dave's been instrumental in that. So before we go to filling his position, Dave, are you on the line? Do you want to address the council?
Sure. Thank you very much, Vince. And thank you, Steve. Good morning to everyone on the line. I just wanted to say thank you for the kind words. It's been a long career, and as Vince mentioned, it's been 3 different jobs here in Santa Fe. So I leave with the private equity portfolio, I think, in phenomenal shape. Chris Cassidy and I have worked together collaboratively for the last 5.5 years on it. I think we've made some great improvements, attracted some great managers, and Chris will be taking over. So the portfolio is in great hands, and I look forward to great things in the future from these permanent funds. Appreciate everybody's time.
Vince, I'm sure that folks are going to want to, give their well wishes to David.
Sure. Oh, you bet.
Yeah, I know. David, you have been phenomenal, especially around the New Mexico program, and just real responsive to, the direction that we'd like to go, the requests we have. And I can't believe you've been at the SIC that long. That just seems crazy to me. So congratulations to you, and I hope you enjoy your well-earned retirement. Are there any other members who would like to speak with David at this time?
This is Harold. I would definitely like to add in, having been chairman of the investment committee for a bit of time. I really appreciate his professionalism and the fact that he has carried out that particular role the way he has. Private equity is very interesting. Has been a huge contributor to the success of the council's investment activities. And I just want to say, David, I just can't tell you how much I appreciate everything you've done. I did look in the mirror this morning, and then I saw that you were retiring, and I'm thinking, you seem awfully young to be retiring. So I got to think you got something else coming along, and I hope whatever that is, it's really cool. But thank you for everything you've done.
Madam Chair. Oh, go ahead, Mike. Thank you, Madam Chair. This is Mike Messina. David, you've been fabulous. Just gonna miss you a lot. Thank you for everything, and good luck in your next flight.
Thank you, Mike.
Madam Chair, this is Tim. And I just kind of echo what Harold and Mike said, what all of us will say. Mike has been a wonderful asset to SIC, and I've enjoyed working with you, David. I've enjoyed working with you, and I wish you nothing but the best going forward. And thank you especially for what you've done for the state of New Mexico. We've seen how this has grown, and you've been very instrumental in that growth. So again, thank you, David, and the best to you always. Thank you, Madam Chair.
Madam Chair, John Bingaman, just like to echo what everyone had said. And David, you know, your professionalism and the program you put in place, the results have just been phenomenal. So hats off to you, and thank you for your service to our state.
Thank you, John.
Madam Chair, this is Debbie. I'm not going to repeat what everybody has said. You know, it's always hard when we lose a good employee, but it's well deserved. So just wish you all the best and enjoy your retirement.
Thank you, Debbie.
Madam Chair, this is Steve. David's insights have been invaluable to us. I've enjoyed working with him for the 13 years I've been here in his various roles. And my hope, David, is that as we've discussed, you will hone your tennis skills and continue to be a star on the court.
Thank you, Steve. It will not be for lack of effort if I don't get better.
Thank you. Is that everything on that topic?
Steve, if I could, let me wrap up by saying that Steve and I have asked Chris Cassidy to step up into Dave's role. We have a great deal of confidence in Chris. As David mentioned, he and Chris have worked together for more than 5 years. And Chris has been there, you know, every minute of the way in terms of improving the performance and structure of the private equity portfolio. So Steve and I have a great deal of confidence in Chris. That's still work in progress. We're still going through the established procedures to make that happen. But hopefully we'll be able to get that done before the end of September when David officially leaves. Last thing I'd like to put in is I'm just so grateful for David's public service. That's near and dear to my own heart, and so I'm grateful for David for that in particular.
Thanks, Vince.
Thank you, Vic.
Let's move to item E, if you would. We'll wrap this up with comments on external relations. Vince and I presented to the Investments and Pensions Oversight Committee on August 15, and you can see our presentation in Charlie's weekly publication. We had our Sovereign Wealth Fund collaboration call that we do quarterly in the month of July. And the members of our, members is probably the wrong word, those individuals participating in our collaboration, which are the CEOs and the CIOs of most of the sovereign wealth funds in this country, would like to come to Santa Fe in person next summer or next fall. We would be thrilled to host them here, and just want the council to be aware of that. If any of you would like to participate when they are here, or if any of you have any comments or concerns about our doing that, please let me know. I think it would be very good, not just for these permanent funds, but also for New Mexico, to stand out as a convener and as a leader in the sovereign wealth fund domestic world, as we have tried to do for the past several years. And we'd like to continue to distinguish our state among these funds. Any comments on that?
Yeah, I absolutely do support that. And dependent on when the dates are that you all are considering, we're also going to be having the National Association of State Land Offices hosted here in Santa Fe.
Yes,
So
thank you, Commissioner.
Even if we can't overlap, you know, when I have my convening, I would love to have you all visit with our folks.
Thank you. We have those dates. Thanks, Commissioner. If there's any way to meld those meetings, we're going to try to do that. I've been asked by the treasurer in the state of Wyoming and the chief investment officer for Wyoming to attend the annual treasurers conference in Saratoga, Wyoming from August 28th to the 30th, along with Betsy Gratzinger, who's the CEO of RBK, and Russell Reed, the former CIO of CalPERS and the Alaska Permanent Fund Corporation. So the three of us will be visiting with legislators, the governor, and staff in an attempt to help them structure their funds in a little bit better way than they are currently designed. And I'm looking forward to doing that. Charlie, would you please comment on current clients and any prospective clients?
Sure. Thank you, Steve. Good news is we now have 26 in-state entities, client agencies that are investing in our pools. The latest to join is the Middle Rio Grande Conservancy District. DFA Secretary Romero approved our joint powers agreement with them last week. And Nicole Gallegos and our investment accounting team are working diligently to working with our custodian bank, rather, to establish new accounts for them. And that could occur as soon as next week. Client number 25, North Central Regional Transit District, is still working on their asset allocation. They should be investing with us by fourth quarter at the latest. And we have at least two other counties that are considering investing with SIC. The 24 active clients we currently have now have $1.7 billion in the SIC investment pools. Or any questions, Steve? That's my report.
Thanks, Shirley. If you would please go to page 15 and let's briefly look at our dashboard. And I want to just point out two or three things that I think are worth mentioning. Our daily net asset value high in the top left-hand corner, you'll see as of August 15 was $38.8 billion. Then moving over to the right side of the dashboard and taking a look at distributions to the state in the top right-hand corner, look at what has been going on since 2018 and the upward trend there. I think you will all be proud of the role that you have played in helping to make those bars consistently move upward. And then take a look, if you would, in the bottom right-hand quarter of that page at contributions and distributions, both from the Land Grant Fund and the Severance Tax Fund. And I'll particularly point out the contributions from the Land Grant Fund in 2022 and thus far, fiscal year to date in 23, as they relate to the distributions from the Land Grant Fund. So if you would take a look at the numbers there, and also dropping down to the Severance Tax Fund, looking at 2022, a very large contribution number, which we were thrilled to receive, and then the distribution number that corresponds to that. In the bottom left-hand quarter of the page, annual land grant inflows from the state land office. Of course, 2022 has been a phenomenal year, and 2023 fiscal year to date is off to a very good start. Then flipping to page 16, if you will please take a look at the bar chart at the top. Severance tax permanent fund inflows, the dark bar to the left is remarkable, and I just would ask you to take note of that. On the bottom of the page, under administration, we've commented on the two analysts that we're looking for. We have 26 authorized full-time equivalents, and we will likely be wanting to increase that number fairly soon. Brent will comment on the investment holdings report and the inflows from the state land office, and that concludes my report, Commissioner.
Madam Chair, Lee?
Yes, Member Ross?
Just for Steve, just a quick comment. Looking at page 15 on that total permanent fund distributions to the state chart that you referred us to, I just think that the bar graph doesn't quite line up with the distribution amounts noted above it. You might just have that reviewed. I'm not sure what's off, but it might be worth catching it. Thank you.
We'll do that, Lee. Thanks.
Anything further for Steve before we move on? All right, hearing nothing, we're going to go on to agenda item 2B. I'll turn it over to Mr. Smith.
Thanks, Madam Chair, and good morning again, everyone. I wanted to do two things this morning, if I could. First, we've been talking about having brought Don Iglesias on as a strategist. The strategy role is one that I know, or I don't think you all are as familiar with. Our investment team is 12 spots. We're divided into two subgroups. Now, those subgroups are transparent, on a day-to-day basis. We all work very closely together. But the one group you are familiar with, and that's the asset class directors, we call them ACDs, asset class director, and the analysts that support them. Those are the folks that work closely with our consultants to find and develop and deliver the individual investments that you see every month. So you talk to David and Keith and Starla and Tom, on a regular basis in your monthly meetings. The other group, and those folks are about 2/3 of the 12 on the investment staff. The other group is myself and the strategists. That role is primarily portfolio level work and investment process oversight. So about 30 to 40% of a strategist's time is devoted to studying macroeconomic conditions, following the broad investment markets, for the purpose of understanding conditions, doing valuation work, considering future expected rates of return from the various markets, and so forth. We develop the broad investment strategies that we talk about in your meetings, and we continuously evaluate our current strategies. We develop the asset allocations for the growth funds, such as land grant and severance tax, and evaluate on a regular basis the efficacy of those asset allocations. Another 25% of time is devoted to working with the ACD's consultants and the ACD's analysts. Of course, the ACDs are responsible for finding, developing, and delivering those investments, but the strategists and I evaluate those same investments from the standpoint of are they coming through and are they being developed through our established investment process? Are the investments consistent with investment policy, asset class structure and strategy, the pacing model for that asset class, and broad portfolio strategies? Are they consistent with all of those things? And when the documents are produced, the ones that you find in your book, we review those docs for consistency with structure, content, and format guidelines before they go in the book and before you all read them and evaluate them. Another portion is portfolio management tasks. So you'll find us involved in the rebalancing of the portfolio on a monthly basis, liquidity management, risk management, policy development, performance reporting, and asset allocation development for the non-growth funds, such as tax stabilization reserve, tobacco fund, and some of the others. Lastly, the strategist and I do investment-related research, studies, and projects, the largest of which that you will recognize as the annual investment plan. So just a different role, focusing on different things than just those individual investments that you see monthly. And I just couldn't be more pleased to have Dawn and Mikhail Kuznetsov as strategists. And as I mentioned before, I'm looking for one more person of their caliber to help with that work. Let me just make a couple of comments about the Fed. That's probably the biggest macro factor today in the markets. The Fed's raised interest rates here. The Fed funds rate, short-term rate, 2.25 percentage points, and they've done it in a period of time just since the beginning of the year. That's about as fast as they've increased interest rates in the past. So the last time they raised interest rates at this rate was back in 2000, when the economy was really getting overheated and the markets had just been on an absolute tear. We were in the technology bubble that was created in 1997, 1998, and 1999. It was the absolute highest valuation of the U.S. equity market ever, according to our Shiller CAPE ratio. It hit 44, which is just an amazingly high number. It's never gotten that high, although we are challenging it today. Last January, I think we hit 39 on the CAPE. Very, very expensive. So that's the last time they were raising rates at this speed. That's in conjunction with forecasts that we could go to 4% on the Fed funds rate, which from the starting point of 0 to 25, a range of 0 to 25, would be a 375 to 400 basis point increase. One of the largest increases they've made at one time was 4.25% or 25 basis points, and that was back in the 2004 to 2006 area, when the economy was really heating up and right ahead of the great financial crisis. So when they raised interest rates at the speed that they've raised them this year, back in 2000, we had an 8-month recession, as I'm sure you recall. And then when they raised them as much as they may raise them, as forecasts are saying they could raise them, in that 2004-2006 period, we suffered an 18-month, pretty nasty recession in 08, beginning late 07 and throughout 08 and 09. So now those interest rate increases did not solely cause those recessions. There were other factors there. But right now we've got a situation where the Fed is both raising rates as fast as they've done in the past and likely are going to go as far as they have in the past. So it's we're really keeping our eye on that. Chairman Powell will be speaking on Friday at the Jackson Hole, the annual Jackson Hole Central Bank Conference. So we'll be watching his presentation and evaluating his words at that time. But the Fed is particularly important today, and I know they probably grew that. They would like to be in the background and doing their job of controlling the price level and managing the unemployment level. But today they are front and center, and it's very much something that we all should be keeping our eyes on and evaluating for the effects on the markets that we invest in. So with that, Madam Chair, I'll stop. Take any questions you have, either about strategists or operations, hirings, or what the Fed's up to these days, as you wish.
Any questions for Vince? Thank you, Vince. Questions from council?
Madam Chair, John Bingaman.
Yes.
Vince, thanks for that discussion. Just a quick question for you on like the inflationary environment and the asset allocation that we have. I know that some of the asset classes were allocated to like real return and real estate in particular, I think, right, are designed to benefit, relatively speaking, in
periods of higher inflation, and maybe equities too, to a lesser extent. Could you just talk about, like, do we think that those asset classes are performing, sort of doing their job in the current inflationary environment? Any thoughts on that?
You bet, Madam Chair and John. So a lot of those, so the main asset classes there would be real estate and the real asset class. Those were the first reason those were put in were for their cash flow properties. So in both of those asset classes, cash income is a material portion of the total expected rate of return. We really were trying to lower the duration of the overall portfolio. So we're taking money out of long duration things like public traded equity, moving into things that generated cash as a way of lowering duration of the portfolio, lowering risk of the portfolio overall. Secondarily, though, we'd had just a very long period of very low inflation, and we'd had a very loose Fed, very active Fed. In fact, global central banks were doing the same thing. That at some point inflation had to come back. So on a secondary basis, we were putting those things in there to protect against that time. It was just that it was so unclear as to when it would start. It wasn't any way to time it. And so as a primary factor, it wasn't, very good. So the primary factor was lowering duration and making the portfolio a little more secure, a little more diversified. But to answer your second part of your question directly, yes, I think they're performing in line. Some of our investments in the real asset area haven't been quite as good as I would have expected in an inflationary environment. The timbers lagged a little bit, or timber has performed a little bit less than I thought it might. Still okay, but a little bit less than I thought it might. But the real estate's held up very well, and some of our other cash flow sort of related investments have been holding up quite well.
Vince, this is Keith. I'd like to make a couple of comments to tack on to that. From my perspective, the real asset portfolio, particularly the energy sensitive components. So if you look at MLPs over the last quarter, they've performed extraordinarily well. And then the infrastructure pieces tend to have relatively higher, broadly defined energy exposure, and all that has performed fairly well. Over the longer time period, timber has not been as strong, but more recently with the lumber prices inflecting as they have, timber's performed probably the best it has in a number of years. And so to that extent, it's correlated with inflation the way that one would expect. A lot of what drives this inflation correlation that we're seeking is correlation of the underlying cash flows. So if you look at apartment rentals, for example, they're priced pretty close to the market, and the cash flows of the lessor relate pretty highly to inflation rates over time. What the factor that kind of is conflated with all of this that makes some of that inflation sensitivity difficult to see is something that Vince had mentioned earlier, and that is rates have gone up pretty aggressively, and that gets reflected in the valuation of assets in relatively shorter time frame than the benefit of to the cash flows, which kind of unfold over time. And so I would expect that this is performing, by and large, the way one would hope.
Thanks for that. Appreciate it.
Thank you, Member Bingaman. Any further questions? All right, let's move on to hearing from RBK on our monthly performance report. Agenda item C.
Thank you, Madam Chair. Vince, for the comments. Good morning, everyone. Can you hear me okay?
Yes.
Okay, perfect. Today we do have the June flash report for your review. Unfortunately, the executive summary didn't make it into this set of materials, but we'll try our best to speak to the relevant takeaways in terms of peer rankings and other information that's contained therein, and I think you'll receive a copy at a subsequent time. So, as always, I'll start with an overview of the capital market environment. I think Vince already provided some great comments in terms of putting the environment into perspective, but I'll do that, try to tie it into the performance of the portfolio. You can take a look at page 18 of the meeting packet, the one-page snapshot of all that is happening in terms of economic indicators and market performance. I think at this point, it's no surprise to anyone that we had a very volatile second quarter, in fact, a very volatile first half of the year. And that was true almost across the board. So not just risk assets that are usually most susceptible to selling off in a drawdown, but nearly all assets, as investors broadly were trying to make sense of this runaway inflation and the aggressive response by the Fed that has happened since, with a number of fairly meaningful interest rate hikes, as Vince discussed. So you can see that in the table in the bottom right corner there, a lot of red numbers for that QTD column, that's quarter to date, so the second quarter, and the CYTD, that's calendar year to date, both of those columns, but even going out a year now because of how meaningful those drawdowns were. A lot of red really across the board, as we'll talk about in a little bit more detail here. So at the top, you can see the S&P 500 down 8% in June alone, and that led to a second quarter being down 16% for that benchmark index that often represents the large cap U.S. equity space. But interestingly, bonds weren't spared in this environment, and not entirely surprising when you looked at what happened to the interest rate market. And we know again that interest rates and bond prices move inverse of each other. So there's that relationship that we've been talking about for quite some time. And you can see that change in the rate environment, in that yield curve. That's the top right graphic, different points in time. Looking at it perhaps on a one-year basis shows just how meaningful that shift has been over a fairly short period of time. And that increase across the rate, or across the curve and all the rates, led to a fairly negative return for the quarter, down about 5% and down 10% for the trailing year. Now that's pretty meaningful for the fixed income space, an area that's typically associated with capital preservation. There wasn't a lot of preservation being provided, and that's one of the risks I think that we've talked about for quite some time, that existed both in the traditional assets, the two hallmark assets of publicly traded equities and core fixed income. Historically, it's been a good recipe in terms of having a diversified approach, but both assets, as we've talked about, were approaching or very much close to their historically high valuation. And then that, of course, presented a number of risks in terms of being susceptible to a correction. And that's fairly unusual. When we go back in time, there's very few instances that equities and bonds experience these types of losses during the same time. So very, very noteworthy, but I think you've been quite thoughtful about that possibility for a number of years, have repositioned the portfolio to really to minimize your exposure to a lot of these risks by diversifying out of precisely those two asset classes. And I think the resulting performance, particularly compared to peers, is testament to that, as we'll talk about. So I mentioned that it is fairly rare for those assets to move in tandem and really to fall, particularly to fall together the way they have. If you would have been just invested in call it a traditional portfolio that sometimes we use as a reference benchmark, a 70-30, so 70 publicly traded equities, 30% fixed income, that portfolio would have given up 17%, would have been down 17% in the first half of the year. So that would have been the deepest decline in the past three or so decades. Again, because of all the things that are happening in terms of high inflation, Fed action, so on and so forth. And so that's a pretty meaningful sell-off on a total portfolio basis. When you compare that to the Langren, that outperformed that 70-30 portfolio by 9%. So it was essentially protected twice as well on the downside. That's a significant margin. Again, almost exclusively due to diversification and portfolio positioning. So a lot of the actions that you've taken over the past years to get to this place. And so as I said, that led to fairly good relative performance. Of course, the numbers are still not where we would like them to be on a total basis, but the markets are what they are. We just try to do as well as we can collectively in that environment. And when you compare yourself to other peers, I know that's something we look at on a periodic basis. Through this environment, the portfolio shapes up in the top quartile for the quarter, and you're actually right there at the top decile for the fiscal year period. So I think that speaks to overall how well the portfolio is working. So there's been discussion about inflation and the challenges that presents. We did see headline CPI jumping to 9.1 for the trailing 12-month period in June, and that was despite some initial Fed hikes that really didn't seem to have the impact that was desired. Earlier this month, the July number came out, and that did tick down to 8.5. Of course, it's still a long ways off of the 2% target. And I thought it was a bit ironic. People were cheering for 8.5 this time around, and it was 8.5 in March, and people were absolutely having a different reaction at that time. Didn't believe it that it was as high as it is. So a few months really changed perception, but I think there's just a lot of hope that number is going to continue to go down. Although I think there's a lot of work to be done. Most of that tick down in the inflation rate was due to a pullback in the energy prices, as was discussed, and so now the worry is that it's really getting entrenched in some of the stickier parts. And there's a sticky CPI index that's interesting to look at as well, and that I think we have in our executive summary that you'll get a copy of that looks at that. And that includes rent and food, things that really don't change as quickly as things like energy prices, for example. So once things becomes once that inflation becomes entrenched in some of those areas, wages is another example. It's difficult to unwind. So at this point, we do have some better performance for this third quarter, these initial weeks in this new fiscal year. Although the yield curve is inverted now, we have, as Vince mentioned, short-term rates that are higher than some of the longer ones, and that typically is associated with weaker economic expectations on a go-forward basis, and oftentimes has led to a recession. So a lot of eyes on that. I won't spend any time talking about commodities. Steve and Madam Chair, you already made some great comments around that, having softened, although it's been a bright spot overall for the portfolio for the better part of this calendar year. The private markets, as was discussed, and that includes particularly real estate and real return, those income-focused asset classes with a direct linkage to inflation. Those were very additive in this environment, and did provide some positive returns overall. And I think you'll get the more detailed reporting from your respective consultants on that as part of today's agenda. So this quarter is off to a better start. It started actually quite strong in July. It's become quite a bit more volatile here into August, but overall we're seeing equities up about 10% for these first call it 6 or so weeks, and fixed income is up about 1%. So directionally better, but still quite a bit to make up. So I'll stop here. Happy to take any questions, and otherwise we turn it over to Marcia for the detailed comments on the portfolio performance.
Okay, so questions for Matthias? Marcia?
Thank you, Madam Chair and Matthias, and good morning all. I'm going to take you to page 20 of diligence and talk about performance ending June 30th of this year. First of all, at the top part of the chart, you can see where you are against your target allocation. Overweights or underweights to some of the private assets have lessened. Part of that is due to the market that you have been deploying assets into your private. But the downturn in the equity market is reflected in closer to your targets than you had been. As Matthias mentioned, we have information from the executive summary that we'll share. You'll get that report very soon, but I'll share some of the highlights from it. As Steve mentioned, relative to your peers, which is not an objective, you've done quite well. And we've gone through a period, as you well know, that the longer term, we didn't see a lot of downside over the last several years. Well, we've certainly seen some downside, especially in calendar year to date through June 30th. So this portfolio, not just with the asset allocation, but with the underlying asset classes, has been built to certainly capture the upside, but also to protect on the downside. And the numbers that I'm going to share with you will show that your portfolio is doing what it was built to do. Looking down at the bottom of page 20 in diligent page 4 of our book, you see returns that are negative, as hinted by Matthias. There was really no escape. For the month, just the month of July, you were down 2.93. But you beat your benchmark during that period. For the quarter, you were down 6.44 for the combined land grant with 6.8. And that's a lot. But I want to share with you that the median plan in this universe of public pension plans greater than $1 billion, the median plan was down 8.9. So you lost less than peers during a very difficult quarter. And if we looked at how you ranked against those peers, you were 21st percentile. And across the board now, from quarter, calendar year to date, fiscal year to date, clear out to the 10-year, each time period your rank is in the top third against that universe of other public plans. So calendar year to date, which was a tough period of time, the land grant was down 8.02. Severances, you would expect it did worse, but both did better than the median plan for that calendar year to date. Median plan was down over 12%. So that gave you a rank against your peers of 13th percentile. For the 1 year, which is your fiscal year to date, you were down. Severance or land grant was down 2.14, which was on a relative basis a very good number. The median plan was down 7.56. So for that period, you ranked in the 11th percentile. And that theme goes on, as I said, through the 5 through the 10 for the 5 year, going out to the 5 year. You see you slightly underperformed your policy index, but the 7.29 positive return was better than median for that 5 year period. Median was 6.4, so you ranked in close to the top quartile for that period of time. So again, just reiterating that in a very difficult period, you lost less than your peers, which pulled up your ranks to a very strong point. And you built the portfolio to do that, again, to capture upside, but also to protect on the downside. Any questions there on page 20? The next 2 pages just look at asset allocation for each of the funds. What's going to then the theme is for the most part the same. You're still funding into some of your private, some of the newer funds like housing, rural libraries are moving towards their target. And just as a reminder, as we look at the next 2 pages, the water trust target to equity is only combined 20%, and it was under that. It was about 16%. So if you go to page 23 and you're looking at, this is calendar year, beginning and ending market values, and then the returns, calendar year returns on the right-hand side. As you would expect, all negative on this page, and certainly depends on that asset allocation that's shown on the prior page. How much equity and fixed income did they have in the portfolio? On page 24, just noticing and commenting that the only positive return calendar year to date was with that water trust, and the water trust again has little exposure to equity, public equity, and pretty significant allocations to the private asset classes. So that was an experience of positive return for the calendar year to date. On page 26, I wanted to take you through each of the asset classes. Not only is the total fund, the portfolio was built again to capture upside, but also to protect on the downside. That's being carried through for the asset classes. I didn't mention earlier, but if we look at the 5-year performance for let's just use the land grant, that 5-year return of 7.29, that you were 112% of the median return, but only 73% of the median volatility. So that's where you want to be. You want to capture the upside, but have less volatility, and that serves you well in this difficult market environment. Looking at U.S. equity, although you can see it trailed the Russell 3000, its benchmark for longer time periods. I just want to point out again that this portfolio has been repositioned to be a little bit closer to the benchmark. And also worth noting that if you looked at how this portfolio, your U.S. equity portfolio, ranked against its peers, it's ranked well. So you're not alone. Many public funds funds in general had a difficult time beating the Russell 3000 post-global financial crisis. So you can see underperformance relative to the benchmark. Portfolio transitions have been completed on this, so it's more not taking as many, does not have as many biases. But again, if against your peers, you've done quite well. The non-U.S. equity portfolio has also been repositioned, and you can see in each time period here that portfolio has beaten its benchmark. The core fixed income and non-core fixed income, although just on the short term, the core fixed income had slight underperformance. It's really nice to see on the core income portfolio strong outperformance relative to its benchmark, which is the Bloomberg U.S. Ag. So negative returns, as Matthias had talked about, significant negative returns for the short term, but doing better than it could have been if it had been past it. Looking at the non-core, you can see the performance there, also outperforming the benchmark. But here the story is more that diversification between core and non-core has been additive to the portfolio. The diversification and the shorter duration of that portfolio has served you well in this more difficult market environment. You do have some cash in your portfolio on the overlay strategies, and then on page 27, you can see the other the private asset classes, and you'll hear more about that today. The only publicly traded is 2% of the real return portfolio, which is what, 0.2% of your real portfolio, and some shorter term adjustable rate loans for a very small piece, and then that small piece of MLPs that remains in the portfolio. So a small portion did well for the 1 year period that had a tough quarter. And I did want to point out on page 29 of diligence, and I know we've got a lot to do, so I'm not going to spend too much time, but I do want to go to the attribution because I think it tells a story. Again, you've been in a great position of getting cash in. Thanks to the commissioner's office, you're getting money in. You weren't always able, it's hard to deploy that in a timely manner. you're cash flow positive. But this attribution tells a story of several stories here. And again, on page 29, which is the full 1 year. The green is the 1 year return, which was down 2.14. Again, a solid, very strong return relative to other public plans, but negative, albeit 1.72% of that negative return came from your strategic allocation. So again, your asset allocation decision is the biggest driver of return. What I wanted to point out about this attribution is you'll see that the tactical asset allocation piece was down 1.13, so that contributed to underperforming the benchmark. And if you look to the yellow on the, what would that be, the second column below, this really gets to the story of having that money and not being able to get it deployed into your private assets. So you were slightly overweight equities, which was a headwind during this period, as you well know, and that being underweight real return, real estate and private equity, that detracted from your performance. And, you know, that's a good problem to have, I guess, that you're getting money in, but it did affect your 1 year return. Because if you look at the far right-hand side, combined the manager value add, which is the purple, indicates that your managers added value during that period. And then the orange is just a very slight impact, but it is really the impact of the asset class structures. So really the story here is asset allocation drives returns, and that's the first column. And then second, not being at your target allocation also detracted during this period, although managers as a total outperformed the benchmark. Madam Chair, I'm happy to take, Matthias and I are happy to take any questions. But during a very difficult period, you did better than most.
All right. Do we have questions from council members? Okay, thank you, Marcia and Matthias. With that, I think we will move into the next section, which is hearing our quarterly reports on the asset classes. We're going to start with the National Private Equity Program Q1 Performance Report. I will turn it over to Mr. Lee.
Thank you, Madam Chair. This is David Lee. I'm here with Chris Cassidy and Richard Pugmire and Amy Ridge of Mercia. This is the first quarter PMR for the national program, and we'll go through the New Mexico program separately after this. These materials start on slide 45, but I believe Richard Pugmire will begin his comments on slide 48 and go through the program. It's been a very busy year and will continue to be throughout the end of the year. Go ahead, Richard.
Thanks, David. I just wanted to start out expressing my appreciation for David as well. We spent a lot of time with David and Chris, both on the current portfolio and also looking at new investments to get to those investment recommendations that we ultimately bring to the council. And one of the things that I really enjoy about my job is the collaboration we have with smart and thoughtful people. And David and Chris are both great to work with, and we're going to miss working with David and wish you good luck. So we're going to cover Q1 2022 performance today. And as a reminder, Q1 is when a lot of the current macroeconomic challenges that we're dealing with today started being more prominent. And in the national program, as you can see on page 48, the overall performance was basically flat in the quarter with a small gain of 0.9 million. And this ends the trend of strong quarterly performance that we've seen going back to Q2 2020. Which was 7 straight quarters of 195 million or greater gains in the program. So really a strong run of performance that we've seen. And even though it was relatively flat for one quarter, you can still see that strength of the recent performance in the 1, 3, and 5 year returns, which are 31%, 23.5% and 19.6%, which were mainly driven by the more recent fund commitments from vintage year 2011 and after. From a since inception standpoint, the 2011 and after funds have generated a 19% return, and the program overall has generated a 13.1% return, which equates to an over $4.1 billion gain since the inception of the national program. And as David mentioned, from an activity front, 2022 has been a busy start of the year with $322 million already approved. And thank you to the council for taking time in reviewing these investments. We know it takes a lot of time. The fundraising market has actually had a lot of strong managers come out to market. We've been taking advantage of getting access to some high quality new names, in addition to doing the high quality re-ups in the program. And we're looking to finish this year strong as well with some strong re-ups and new managers in the pipeline. I'll quickly go through the following slides. On page 49, this slide has our typical summary of the numbers in the portfolio. Net asset value decreased by 14 million, which also reverses the trend of net asset value increases that we saw going back to Q2 of 2020. I'll talk a little bit more about what drove that on the next slide. Year over year, this table shows the impact on net multiple and net IRRs since inception numbers has been positive, with the overall multiple increasing to 1.65 from 1.54, and the since inception net IRR increasing to the 13.1% from 12.3%. The next slide goes into more details, page 50, on what drove the net asset value changes. Growth strategies really was the strong driver of performance, which offset the losses seen in buyout during the quarter. You could also see that we had more funds reporting net losses than net gains, with 39 funds reporting gains versus 62 reporting losses. But the size of the gains were larger, which led to that $0.9 million gain for the quarter. The graph below shows the changes in the net asset value, and both contributions and distributions were lower in Q1 than Q4, which wasn't surprising because we've seen both investment and realization activity slow down. But I think distributions were actually still strong at 132 million, particularly when you consider what was happening in the world in Q1. And to give you a preview of Q2, contributions were lower at 102 million, but not significantly lower from what we saw in Q1. And Q2 distributions were about the same at 134.5 million. So the portfolio is still generating good value despite the volatility in the public markets. On page 51, this shows the top contributions, distributions, gains, and losses. And in the gains and losses, you'll see that we had some sizable gains, but also some sizable losses, which is different than what we've seen in many of the prior quarters, where we had the sizable gains, but not really the large losses that were offsetting the gains that we were seeing in the different funds. And one of the themes that we saw in the portfolio in the first quarter is those funds with publicly traded holdings were impacted with mark-to-markets. Also, funds that had European exposure were impacted, as 3 of the top 5 funds that you see in the top losses category have European exposure. And these funds got hit by a decline in market multiples, in addition to negative currency effects as the euro weakened against the US dollar. Overall, though, private companies were not as impacted as many of these European or publicly traded companies, as they're still generating strong performance in the first part of the year. And that so far has offset any declines in the market multiples, but I think this is where the concern is with the portfolio as well. If weakening continues, we could start seeing more losses if economic conditions start impacting company performance. The next page shows a by vintage year look of the portfolio. Really, there hasn't been any change here. It's been the same story for multiple quarters now. And most of the performance is actually above median, which is the goal that we're seeking, because we are seeking to build a diversified portfolio in each of the vintage years. 2013 was impacted by some funds that were focused on Asia and energy. The energy has come back slightly, but a lot of that value has been realized, so they didn't benefit as much from energy as a newer fund would. The next page shows a different benchmark, comparing it against some public indices, including the MSCI ACWI, which covers multiple countries and geographies, including the US, Europe, and Asia, which is similar to our focus on the national program. The national program's outperformed the MSCI ACWI by over 5%. It's not surprising to see this because we did see changes in the declines of the public equity indices, but not the same declines in the private equity portfolio. So right now, the private equity portfolio looks relatively better than a lot of the public indices on this page. And then finishing up on page 54 for the national program, just to go into more details on the different strategy components and where we stand. From a pacing standpoint, we're at $322 million of commitments through June. We've been getting healthy levels of distributions, as you've seen in the prior charts, so we're still comfortable committing capital to funds. Some strategies and geographies are all within target. And from a concentration standpoint, a lot of the managers that we have a large exposure to have actually been performing quite well. There's no managers above 10%, but the two that are above 9% have an overall performance of 18% and 24%. And same with the fund series as well. There's 5 currently above the 5%, but performance really ranges from 17% to 39%. So they've been strong performers in the portfolio. And even though we are looking at new managers, we have been disciplined over the years at adding new managers. We have a high bar before we bring a new manager in front of the council. And we've made commitments to 32 managers since 2011. And a lot of those managers that we're looking at in 2022 and 2023 are hard to access, strong performing fund managers. And there's been about 10 managers of that 32 where we haven't done a recent re-up either, but we continue to evaluate it as funds come back to market to make a new commitment. With that, I'll conclude my remarks and happy to answer any questions you have about the national program.
Great. Questions from council? Okay, hearing none, we're going to move on to the Q1 report for the New Mexico program, and I'll turn it over to Mr. Lee and Mr. Cassidy.
Thank you, Madam Chair. This New Mexico program materials start on slide 66, and Richard probably will begin his comments on slide 69. This program, as the council is aware, is mainly venture capital, a lot of early stage companies. So that's been fairly volatile recently. And unlike the national program, which is a lot more diversified, we hit on a 0.6% return for the first quarter, but the trailing 4 quarters is 2%. So there's a significant difference there. If Chris doesn't have any introductory comments, we'll just turn right over to Richard.
Turn it over to Richard.
Yeah, as David mentioned, quarterly returns were up slightly in this program by 0.6% in the quarter. When you look at the details of what was driving the performance in the quarter, the older fund investments were down 3.5%, while the 2016 and after vintage year fund investments were up 2.3% for the quarter, which led to the overall fund investments being up an overall 1.3%. And the older funds are a much smaller part of the current net asset value now, so they don't have as large of an influence on overall performance. The co-investment funds were actually flat for the quarter, but there was actually some performance changes among the different tranches of the co-investment fund, which we'll talk about later in the presentation, which have both good news and some bad news from market movements. When looking beyond the quarter, we've had positive contributions from all the categories except the older fund commitments. The new fund commitments made since 2016 have made a difference so far with about $67 million of value and a 26% net IRR. But these are largely unrealized gains at this stage, as we haven't seen that sizable realizations in the New Mexico program that we've seen in the national program. And because a lot of these investments are newer, there could be volatility in these numbers going forward. From a commitment activity perspective, we've done 2 commitments so far in 2022 for $15 million. We've had a couple of new fund opportunities that we're deep in due diligence right now for a future meeting, and another re-up is actually coming to market shortly that we want to take a closer look at. It's actually done a lot of good for New Mexico, in addition to performing pretty strongly. We continue to meet with the fund managers about different fund managers, both new and existing, about the New Mexico program. And right now in the program, we have unfunded commitments from the funds of about $65 million at the end of June. So that's the amount of capital that the managers are currently looking to deploy into investments, which includes New Mexico companies for potential investment. The next page, page 70, shows the overall performance for the program. The overall net asset value did increase slightly by $7 million, which is driven by contributions in the quarter and also the small gain in the portfolio that we talked about. Since inception, net IRR year over year has increased from a 1.5% to a 1.6%, really driven by those newer fund commitments that we previously spoke about, and also the positive performance of the recovery fund. You can see on here the year over year comparison. The recovery fund was actually still in the J curve a year ago, had negative performance, but it's now tracking at a positive 1.6%. The next page goes into more detail on the net asset value changes. We had 14 funds report gains and 14 funds report losses, so an even number, but the size of the gains were greater than the losses, which led to that $2.8 million gain that we saw in the portfolio. The contributions were $6.8 million, which drove that $7 million gain to the net asset value, as it was partially offset by the $2.3 million of distributions. Regarding distributions, you'll notice in Q4 we did have that sizable amount of distributions of $25.8 million, which was driven by the recovery fund, which has been having loan repayments in addition to the regular interest payments. In Q2, we ended up having about $18.6 million in distributions as well, which is largely driven by the recovery fund continuing its distributions. The next page goes into more detail on the top gains and losses and contributions and distributions. And you can see that the co-investment funds actually had both the largest gain and the largest loss. There was a company in the 2017 tranche that was written up due to new financing received at a higher valuation. So that was positive news in the portfolio. But there's still exposure to a publicly traded company that continues to impact some of the other co-investment fund tranches, especially with the weak public equity market, as the decline in the stock prices has been a drag on overall performance. There's actually another sizable publicly traded holding as well in one of the newer fund commitments that was hit hard in Q2, and we expect that will be a drag on performance for Q2 as well. For private company valuations, though, it's important to remember that venture capital in particular may be slower to reflect lower valuations, as we may see smaller changes with market movements, but larger changes typically come when a company raises new capital, like we saw with that large gain, or there's a significant change in company performance. But we are seeing volatility from the publicly traded holdings now, but there could be more volatility from the private holdings going forward when they have to return to market and raise more capital. Page 73 summarizes the economic impact numbers from the New Mexico program, and we're up to 116 New Mexico-based companies receiving investments, with 57 of those being active in the fund portfolios and 59 have been realized. 15 of those companies have been funded over the last 12 months. And you may note on that line of 15 that there's 3 that are already in the realized company column, as there were recovery fund investments that paid the loans back quickly. And we wouldn't expect to see that from the venture capital funds, where hold periods are expected to be multiple years. The total invested from the SIC is up to $380 million, and at the fund level, So that's including the capital that's in the fund that invested in New Mexico-based companies. That's at $499 million, with more than $47 million invested over the last year. And there's 5 companies no longer in New Mexico and 25 companies reported receiving government incentives, which hasn't changed quarter over quarter. The next page goes into more detail on economic impact with jobs, payroll, and expenditures. The job numbers didn't change too much quarter over quarter, with 4,414 New Mexico jobs reported. And most of those are in active companies. And a lot of that number came from the New Mexico Recovery Fund investments, as those funds have invested in more mature companies that have a large number of employees compared to what we see with the venture capital-backed companies. And the job growth since inception is at 1,756. So that's the job growth since the SIC first made an investment in a company. And a lot of that recently has come from the hotel and leisure companies in the recovery fund. There was a slight increase in the payroll numbers. They were up 2 million to 201 million. And the expenditures also increased by 16 million to 232 million. So that summarizes both the investment performance and then also the economic impact performance of the New Mexico program. We have some other slides that go into more detail on the portfolio composition, but I'll end it there and happy to answer any questions.
Thank you very much. Questions on the New Mexico program? All right, hearing none, we will move on to real estate. Turn it over to Mr. Sable.
Madam Chair, good morning. This is Keith Sable, Director of Real Estate and Real Returns. I'm joined this morning from Townsend by Steph Marcus, Stephen Hartenstein, and Teddy Grodzinski. Let's jump right in with a couple of introductory comments from the PMR perspective. The content for this portion of the presentation will begin on page 90 of the board books. Keep in mind that the private market data is accumulated and reported with a significant lag as we go through this information. And then I would highlight again that, as Vince and Richard previously mentioned, the market environment has changed markedly from Q1 with the Fed embarking on a historic rate hike cycle. The implications of that are that with higher rates and the market beginning to reflect some worries about recession, these are significant valuation inputs that suggest that the short-term outlook is probably not as sanguine as the recent past. Diving into category-specific commentary on real estate, while we're ahead of the Odyssey benchmark for longer periods, the portfolio did lag by 80 basis points in the quarter, nevertheless still up 6.3%. On the real asset side of things, the MLP position was up about 25% for the quarter on the back of higher energy prices. Some of that related certainly to the geopolitical risks around the Ukraine. Infrastructure generally was a strong contributor to performance in the real asset side of the book. That's a function of the large size of the exposure and the fact that a lot of infrastructure assets have some exposure to the energy markets more broadly. Before I steal more of Steph's thunder, I'll hand off to him for more detailed comments. Steph?
Thanks, Keith, and good morning, everyone. So I think the first thing I wanted to mention is the question early on that was asked about the inflationary environment and how the portfolios are positioned. And both Vince and Keith answered those questions. I just wanted to add one more comment and sort of think about how we think about that, how we think about the portfolio from a diversification standpoint when it comes to the inflationary environment. So when we think about different asset classes within real estate, a lot of the inflation the correlation to inflation is captured in the rents that are paid to us as owners of the assets. And Keith described this, but when you dig down a little bit deeper, you think about each asset class, the rents are sort of can further provide additional diversification. So in the case of office assets, those tend to be the longer term leases, 5, 10 plus years. They do typically have some CPI or inflation adjustment within them, but those are typically also capped. Those adjustments on an annual basis. And then on the other extreme, hotels reprice daily, right? So you see the constant adjustment there. With inflation, apartments are somewhere in between, typically a 1-year lease, and industrial tends to be 3 to 5 years. So how we think about how the portfolio is positioned within the asset classes also provides additional diversification and provides correlation to the inflationary environment. So I wanted to add that to the comments that were made earlier before going directly into the PMR here. So as Keith mentioned, it starts on slide 90 or page 90 of Diligent. On the performance chart starts on 93. And as you know, we did a pretty deep dive on the year-end performance a couple months ago, where we provided a summary of every investment in the portfolio. The 1Q data is typically a bit more muted, given many of the funds use that year-end timeframe to perform annual appraisals alongside their audits. So with that in mind is the performance that Keith highlighted of underperformance, 8 basis points for the quarter. However, significant outperformance over all other time periods. We do see the 32.5% annual net return over the 1-year period. This is above and beyond our expectations and 520 basis points of outperformance. But the short-term quarterly underperformance is really primarily due to the valuation timing. We anticipate this return sort of moderating going forward. And the fact of the matter is that just some of our managers have moderated ahead of our index, our benchmark, the Odyssey, which we think will sort of catch up over the back half of the year. So consistent with some of my past comments, much of the overall real estate return has been driven by some unsustainable returns over the past year, where real estate typically generates 7 to 9% core return annually. And we see that in single quarters throughout 2021 and now have this 32.5% return over the 1 year. The first quarter, and then we talk about the second quarter, as everyone has said before, are going to be pretty interesting times. The bigger macro events are happening all around us. But within real estate, values do tend to lag the broader economy. So additionally, within real estate, the fundamentals have remained strong. Property types, specifically within industrial, demand in industrial with limited supply has created an imbalance there, where the value of our industrial assets have increased significantly and remain basically 100% occupied. And then alternative sectors and multifamily and residential also have very strong fundamentals, which is where we target additional overexposure within our portfolio. To this point, the second quarter numbers, so we are looking at first quarter here, but the second quarter Odyssey benchmark reported a pretty healthy 4.5% net return, despite the rise in interest rates and inflation and the negative GDP numbers we talked about, as well as the ongoing war in Ukraine. So we do project the remainder of the year, the third quarter and the fourth quarter, to be flat to a 0% return for many of the core funds. But we'll see how that sort of shakes out over the next couple months. Our sector exposure continues to drive our outperformance. We have an overweight to industrial, about 4% overweight relative to the index. Our alternatives exposure is about double the index. We have 13%, where the index is about 7%. And then we're underweight to office and retail, which is where we want to be, given the demand of those asset classes. So we remain well positioned in both a contracting economic scenario as well as when we start to grow again. We are seeking, and I've mentioned this probably for the better part of over a year now, an increase to multifamily and residential exposure. And we are slightly underweight on net asset value basis, but with our unfunded commitment, we anticipate to be at a minimum market weight when that's called, and we've got some additional commitments that we're looking to make going forward. So getting back on track in the presentation, slide 94 is one that we focus on specifically in times like these, where real estate is an income-generating investment and asset class, as described earlier. Our income year in, year out has remained strong since 2011, since really the restart of the portfolio. Regardless of what was occurring in the broader market and the economy, we generated and collected rents and income during COVID, and we expect that the same going forward. With the income historically around about a little over 4% of our portfolio, of our total return. And this is why we remain comfortable as the portfolio is a bit overweight to open-ended funds, which highlights some of the comments here. We target a 55% allocation to core open-ended funds. We've got about 67%. But given their higher income component, we're comfortable with that overweighting. and the way the portfolio is positioned today. Part of that overweight is also due to the inflow that was talked about at the land office, where we can get that money invested and allocated to real estate quickly. Further, we don't anticipate this to impact our returns, although it's core performance, core risk, and core return. And as you can see, it hasn't impacted our returns historically. We stand fully committed to the 2022 vintage, as highlighted on slide 95. We did overcommit a bit this year already, and last year as well. And you've also seen in the RVK report that real estate remains under the target allocation. So as of all these commitments are called, we do anticipate moving closer to the 12% allocation in the coming quarters. And we do looking forward. We recently already talked with Keith and Vince and are beginning to plan for some 2023 commitments to really high quality investment managers that could actually occur before the calendar year end here. On the topic of allocation, as of quarter end, we were at about 10.8% versus our 12% target. This was a 40 basis point increase quarter over quarter as the growth of the real estate portfolio outpaced the overall plan. Just to put some dollars behind that, the portfolio increased $300 million on a net of distributions quarter over quarter. Again, that was sort of a record increase, and that was driven by both capital calls and also increasing values within our portfolio. The allocation is obviously something we're looking at closely going forward as these numbers are adjusting and commitments approved have been committed over the last 2 years, and looking at that sort of over allocation of core and seeing if that needs to be further adjusted. On slide 96, I always stop here, given really the magnitude of the numbers on this page and the fee savings. So just to reiterate, through New Mexico's collaboration with Townsend, we're generating nearly $2.5 million of annual fee savings. And again, this is not compromising on the quality of the managers just to get lower fees. We don't go with the lowest cost provider. We find high caliber managers and funds, and then negotiate fees after that. And Townsend clients like yourselves across our platform helps us benefit from fee savings. We're able to do this really because of the large and sophisticated active clients like yourself, as well as about approximately 100 others across our platform that we can use to help negotiate a better fee for our clients. The balance of the slides are mostly ones you've seen before. There are a couple more significant events, and those are highlighted on page 99 in the first quarter. There was a succession and executive change at one of our partner managers, Bell. This was part of natural succession planning, as well as in Berkshire, some redemptions from some of the original family capital that was in that fund, as well as an increase in their leverage. This redemption and leverage increase is actually something that Townsend had been behind and pushing very hard for Berkshire to do so. With our seat on the advisory board, we think this was hindering the growth of the platform. I think it's better positioned today, given where we sit, where it stands. Lastly, and you heard this in the private equity presentation, we do a PME equivalent comparison on slide 104. Here, you'll see that there were about 40 basis points of outperformance since the inception of the full real estate portfolio, and then 390 basis points of outperformance when you just look at the rebalanced portfolio since 2011. So with that, I'll stop here and see if there's any questions.
You guys will have to excuse me. This is Tim. I've got to check out. I've got a city council meeting I have to go to. Sorry.
Okay. Thank you, Member Jennings. Any questions for Seth or Mr. Sable at this time on our real estate Q1 report? Okay, if we could turn to real return, agenda item 2G we are on.
Okay, great. Madam Chair, since I've already made a few introductory comments related to this, I'll just hand directly over to Steph.
Sure, thanks, Steve. And this is, I'm going to start on slide page 130. So the portfolio here, the real return portfolio currently represents 9% of our total plan assets based on market value. This is about a 20 basis point increase quarter over quarter. And the financial assets and the MLP portion of this portfolio make up about 23% of the total, with the remaining 77% being to that real assets allocation, which is infrastructure, timber, agriculture, and energy. Overall performance is noted on slide 131, with the first bar being the full real return portfolio performance, and the second is just including that real assets portion. So during the first quarter, in the 1 year period, portfolio outperforms our CPI plus 300 index. And then similarly to real estate, the 1 year return reflects a combination of recovery from the 2020 vintage, but also strong fundamentals, and private markets also lagging our overall economy. And again, this is first quarter performance. Over the 1 year time frame, both the real return and real assets performance independently outperform by 660 basis points and 300 basis points respectively. As a reminder, so the significant difference between these two is that MLP position. I've referenced this in the past, but the volatility there is worth mentioning again, given the public market exposure to the energy sector. So this position produced a 1 year net return of 49%. Yet when you look at the inception of the portfolio of MLPs, it's relatively flat, just slightly positive over its life. In the first quarter of 22, we generated a 25% single quarterly return. This is after being flat in the third quarter and fourth quarter. So that was, again, during the first quarter when energy prices were obviously increasing. Moving over to slide 133, the remainder of the portfolio or presentation really focuses exclusively on real assets, and that allocation is 8%. Based on our first quarter market value, the real assets represent about 7% of the total plan assets, or 8.6 when including unfunded. On a dollar basis, the portfolio increased $80 million quarter over quarter. Again, a combination of capital being invested as well as growth of the portfolio. We anticipate this allocation to increase. We've got a lot of uncalled capital here, and that's being deployed to new commitments, as well as two new commitments that we're talking about just later today on the agenda. The last thing I'll really highlight here is the strong sort of 14.5% 1 year return, and this is I'm jumping ahead to page 136 in the interest of time. So consistent with past results, this is a buildup of that 14.5% return. You can see infrastructure and energy being the two leaders. This is consistent with history, and that's really due to the size of those portfolios combined with the overall return. So infrastructure has been the leader there over the last 5+ years, and it's where we focus a lot of our remaining new commitments. And to that point, infrastructure represents about 49% or $1.2 billion of the total NAV within this portfolio. Energy, the other major contributor, 4.9% return or 4.9% contribution to that 1 year return. And as the energy sector continues to benefit from those valuations in the first quarter. And that's just a reminder that this was sort of when energy prices were on a considerable rise. Our dedicated PE energy exposure is a question that we typically do get from members of the council. So we do stand at about 28% total energy exposure. That's across both our dedicated energy investments, but also we've got some energy exposure within the infrastructure portfolio. So as highlighted, all the other sub-portfolios contributed positively for the year, but just had a really minimal impact due to their relatively small size. So I'll stop here again and talk for a little bit here and hope to answer any questions.
Thank you, Seth. Questions from council? So Seth, does that complete your report? I'm sorry.
It does on the two performance reports, yes. Yes, okay.
All right, then we'll move to the very last Q1 report on private credit. Mr. Lofton.
Thank you, Madam Chair. This is Tom Lofton, Fixed Income Director. I'd like to direct everybody to page 156 of the meeting materials. So to present from Axios today, along with me are Trevor Jackson and Dylan Herman. But before turning it over to Trevor, I'd like just to make a couple quick comments. As amply noted and documented, the SIC is currently experiencing significant net inflows, which is now put to work, as RBK pointed out earlier, can create various drags on performance. Keith Sable, my predecessor here in fixed income, in Axia, presented a non-core fixed income pacing study in February of this year, which estimated the amount of capital that needed to be deployed annually to achieve and maintain target allocations. That number was $900 million, which, when accounting for various diversification needs, is not a small task. And if the council approves the commitment recommendations in the pipeline for the remainder of the year, along with Keith's progress through the first half, we are on pace to hit our deployment target of $900 million. So I'm inheriting a program with solid momentum, and I hope to keep that momentum going forward. So with that, I'll turn everything over to Trevor.
Thank you, Tom. Good morning, Madam Chair and members of the council. Trevor Jackson with Axia. I'll just dovetail on what Tom said. When we look at such high utilization of the portfolios, really looking at a higher allocation to private credit. Private credit, we know the market's been pretty volatile, and I'm going to walk through this report today that is through March. So it's typically a lag in private markets, as we all know. But private credit held up pretty well. There's a lot of, benefits to it, obviously. They tend to be floating rate. They're not mark to market. So you don't see some of the volatility that's there. And so that's benefit. And obviously, the whole point is to get higher yield and higher returns out of that portfolio. And, if you recall, historically, there were some hedge funds in this portfolio. And then, building out a more true private credit in this arm was really important. So from our standpoint, diversification was something we really wanted to kind of highlight. We wanted to highlight, high conviction managers with higher commitment amounts, especially as we're raising to $900 million, to Tom's point. And I think, we've done a pretty good job of, with staff able to do that. So I'll go to page 167 in the report, and you can see, performance through 3/31, positive for the quarter, 0.6%, and then the 1 year short term is 7.3%, and 3 years 6.2%. And so pretty healthy returns there that you can see. And that's additive to the overall portfolio when, comments were made earlier about, kind of the publicly traded fixed income having its challenges in a higher increasing rate environment. You look at, the bottom of the page, you'll see that, so far we had $625 million in commitments for 2022. Our Verlaine, distressed manager, senior investments, stress and distress in mid-market companies, Acor, real estate credit in the portfolio, Sixth Street, which is, their TAO product, which is amalgamation of their direct lending, opportunistic growth capital. But again, another one, which at $250 million we gave. And then lastly, foreign capital with structured credit, kind of in risk transfer, RMBS, asset-based items, land banking in U.S., Europe, primarily. So a good diversification of strategies and returns that, are pretty healthy. When we go to page 168, you can see your breakup sector portfolios. We've got the legacy, that's relatively small. You can see NAV for that being $17.4 million. The bulk of the assets are, distressed/other, lending strategies, your public strategies, and structured credit. And, we really spend most of our time in the distressed other category, lending strategies, and structured credit categories. So you can see those are kind of the biggest unfunded plus NAV numbers. And you can see the contributions there to the upper right-hand corner, and distributions as well. So coming along in the lending strategies and structured credit, and you can see that the legacy has kind of larger distributions, not surprising because those are the older holdings in the portfolio. Bottom right hand, you can see kind of distribution of types of strategies, and you've got global direct lending in the portfolio, structured equity, structured credit, fixed income arbitrage. There's still some hedge funds in the portfolio, which actually did pretty well in Q1, given the volatile market. European direct lending and U.S. direct lending. And so the key is to have a pretty diversified portfolio, and you have that here. Moving along to page 169, this is what we call our value bridge. And so we kind of ran it for 1 year, ending March 2022, and 3 years. And you can see that here that, from a gains and loss, $237 million over the last 12 months in the portfolio. In the last 3 years, $679 million. A fair degree of distributions as well as obviously contributions with capital calls as we continue to increase the number of commitments on an annual basis. Looking at page 170, performance. And, we've got a couple benchmarks here. When you look at, you can see that you're outperforming really across the board. When you look at year to date, 1 year, 3, 5, and 10. And you've got a couple of benchmarks here. We've got that gray box is really T-bills plus 400. So that's an absolute return, and that never really goes negative, right? So that's a tougher one to beat in a pretty volatile market environment, but you held up in year to date and outperformed from a 1 year and cumulative standpoint. And then you see that negative 1.15% on the benchmark, which you outperformed. And that down at the bottom is an amalgamation of some high yield and leverage loan indices that had its challenges in early part of the year. But again, outperformance really across the board in this private credit portfolio. We're happy to see that. Page 171 really just kind of gives you a picture of kind of what was our parameters and our objectives. And so we already talked about, $900 million pacing for 2022, which we did earlier in the year. And you can see kind of long-term targets for the strategy mix. Public markets between 20 and 40%, structured credit between 20 and 40%, lending strategies, which right now kind of has a lower allocation and at 20 to 40% in its target, and then distressed and other at 20, 40%. And you can see the numbers kind of where they are today. We've committed names to lending strategies. We have other lending strategies for the rest of the year to commit as well. And as they start to call capital, you'll see those percentages kind of come up to more in the range. So not so concerned. We've got a couple of names that in the docket for next month in October and potentially in November, and that it varies. And that could be, European direct lending, U.S. direct lending, infrastructure debt, and some other distressed names. One of the considerations as we think about a potential recession, a more than likely recession, is, the distressed market becomes more palatable. And so having names that can really take advantage of some dislocations in the marketplace over the next year is really important. Going to page 172, I'll just highlight, a couple of these graphs here. The upper left-hand corner, you can see that you've got pretty good vintage year diversification. And those numbers just get larger as the last few years you've been putting more capital to work, so not all that surprising. And then, to the right, you'll see commitment level. For 2022, the dark tealish color includes what you kind of committed. And then we've added numbers that are pending, that we've approved, but no money has kind of been called yet. And that gets you to your $625 million I mentioned on the first page. And then obviously, we're looking to do $900 million this year before the year's out in commitment. Only other thing I'll point out is the bottom right-hand corner. Remember, this is private credit, so we're investing in a number of industries. And you can see that, pretty diversified. You've got technology holdings, you've got consumer-oriented holdings, food and beverage. You've got some retail in there and healthcare, software services. One of the concerns is, area that's done very well the last few years has been technology. And you've had managers that have done very well in this space. And you've seen, the venture space and the private equity side kind of come down. And, there is some concern on tech names and being able to hold up. But they've held up so far pretty well. But again, having a diversified portfolio means that you're taking advantage of the exposures in a wide range of company environments. And the last thing on the far bottom left, you can see geography. Most of your exposure is North America. And you can see that you've got some Asia Pacific, the biggest second area being Europe. There were some comments on currency earlier. But again, all the managers we have brought to the table are high conviction managers for us, ones that have navigated multiple environments in a European exposure, as well as been able to add value even with, some of those currency translations. So we're not so concerned about that. We want to be able to have some good geographic diversification in the portfolio, even though we're still U.S. biased. I know, I went through that relatively quickly, and I know want to keep track on timing, but I'll pause there and see if there's any questions from the council.
Thank you. And I'm sorry, I didn't catch your name, from Axia?
Oh, Trevor Jackson, Axia.
Trevor. All right, thank you, Trevor. Questions from council? So does that complete your report, Trevor?
Yes, it does. Thank you.
Okay, very good. Okay, hearing no questions on the Q1 reports, we're going to move on now to the investment items, the voting items, and this is where I'm going to bow out, Steve, so not sure how you want to handle it, but I could turn it over to Harold. He's going to need someone to help with motion, so.
Yes, Commissioner, if you would please turn it over to Harold, that would just be great.
All right, Mr. Lavender.
Yes, ma'am. I'm happy to be here and be happy to take over for you. I'll try to do the same kind of job you do. I think we can move on now to the investment matters. Rather than cover any of the, I think everyone has read, I'm assuming everyone has read the investment committee report, and a lot of the things that were covered in that, of course, have been covered already today. We have two investment matters to vote on today, and then a couple of other matters after that. We've got a couple of things to say when that comes. So what I'd like to do is to turn this over to real return, 3G. Vince, do you have anything you want to add prior to Keith making this presentation?
No, thanks, Mr. Chair. Let's go right with Keith and Townsend.
Okay, Keith, take it away. Keith, you may be on mute.
I was indeed. Thank you, Mr. Chairman. I apologize for that. The content for this portion of the presentation begins on page 183 of your board book. The first investment recommendation is that we commit $100 million to Brookfield Infrastructure Fund 5. Joining me today, joining Townsend and me today, will also be Sam Pollock, the MD from Brookfield Infrastructure Group, who's also the CEO of Brookfield Infrastructure Partners, and Chris Harris, the Managing Director of Client Relations. This fund will be a re-up, and it's our fourth commitment to the fund series, and that's excluding two prior co-investment vehicles. Brookfield is seeking to raise $25 billion for this portfolio. Brookfield is one of the world's largest investment managers with over $690 billion in AUM, managed by a global staff of 1,000 plus investment professionals. That global footprint comes with some pretty tremendous sourcing benefits that we find quite compelling. Brookfield Infrastructure 5 will be a core plus value add infrastructure fund. Brookfield will leverage its unique sourcing capabilities to acquire, control, or co-control equity positions in high-quality brownfield assets, where control will enable operating teams to execute value-creating business plans. The fund's target return is 10% net, with about half of that coming in the form of a cash yield. Among the key attributes that we find compelling about the fund are, number one, Brookfield's scale and depth of experience allows the GP to execute large, complex transactions where there's less competition in the market. About 2/3 of their closed deals have been bilateral arrangements. This contributes to portfolio diversification by ensuring that most positions will be unique to the Brookfield Infrastructure 5 portfolio and therefore not held in or by other of our GPs. The global footprint enables the GP to exploit regional dislocations as they occur, And then fourth consideration, ESG is an important part of Brookfield's decision-making process, and ESG standards are actually pushed down to portfolio companies. Finally, the GP makes a superior commitment in terms of capital commitment to the overall fund, and that maximizes our alignment. Brookfield's going to commit 25% of the fund's capital at a corporate level. After weighing the benefits and risks, staff and Townsend recommend, again, an allocation of $100 million to Brookfield Infrastructure 5. With that, I'll hand off to Seth for his comments.
Great, thanks, Keith. And I'll keep these pretty brief. Keith did a great job of explaining the story here, and then I'll pass it over to the Brookfield team. But just to reiterate a couple of comments and add to it. So this is a follow-up commitment to existing manager that's not only performed well, but it's also one that's highly rated here within Townsend as a buy-rated fund. So of those commitments that Keith highlighted, we've made to Brookfield. They total $400 million, and that goes back to 2013 when we started investing with Brookfield. So this includes commitments to funds 2, 3, and 4, and then the 2 dedicated sidecar commitments. One was a co-investment vehicle, and then another dedicated renewable power vehicle. Additionally, we do have exposure to Brookfield through our timber and our agriculture portfolios, as well as the debt portfolio. So our total exposure to Brookfield in the real return portfolio is about 15%, and that's inclusive if this $100 million is approved today. So about half of our policy limitation at 30%. Interestingly, that each of these funds is closed-ended, so that capital will get returned back to us. It's not long-term capital, so we're seeking to sort of replace capital as it comes back. At the target fund size of $25 billion for Fund 5, this is Brookfield's flagship infrastructure fund, really focused on acquiring diversified portfolios of value-added infrastructure assets, as well as asset-backed companies located predominantly in Americas, but also Western Europe and the Asia-Pacific region. Brookfield's obviously a well-known sponsor and a publicly traded entity. Across its prior 4 funds that were invested in, the firm has raised approximately $44 billion in total commitments, is invested $33 billion of that across 56 individual transactions. So large-scale transactions, large-cap transactions, with realizations at about $16.5 billion there. So producing strong returns of about 11.7% net on a total value sort of paid in capital of 1.4 times. And that's all in US dollar, given some of these investments are made abroad. I'll let Brookfield describe the strategy. They'll do a much better job than I will. But we do feel that the fund differentiates itself from its peers by its truly global footprint and its ability to execute really large-scale, complex transactions, and really an owner-operator mentality with the ability to use its operating platforms to execute its value-add business plans. Before passing it along, I just want to mention or follow on sort of some of the comments that Keith made about the competitive advantages that we highlight in our recommendation. It is the strength of this platform. And have proven throughout their track record, also the ability to execute on those complex transactions with strong alignment. We do highlight a number of sort of risks that we wanted to highlight. Those include, it is a large fund at $25 billion, as well as the size of Brookfield as a whole. There's some concern potential about overlapping strategies within the platform. We believe that each of these potential risks is very well mitigated, as outlined in our report. I'm not going to read that directly, but it's in there. And happy to answer any questions that anyone might have on those. But in the interest of time, maybe I'll pass it along to the Brookfield team here to talk about the fund.
Great, Seth. Keith, thanks very much. It's Chris Harris. I'm with Sam Pollock, who's the CEO of Infrastructure. First of all, Mr. Chairman, members of the council, it's great to hear a lot of familiar voices. New Mexico has been one of our longest and most important clients, so we really, really appreciate it. I'm going to pass it off to Sam, but I think one of the things I just want to mention for folks that maybe aren't familiar with us is we're one of the largest real assets managers in the world with about $725 billion of assets. But one thing we actually are quite proud of is the fact that we're a corporate citizen in New Mexico. We've got about $600 million of assets in New Mexico, both in real estate and infrastructure, including the solar array that powers the treatment plant in Santa Fe. So with that, I'm going to pass it off to Sam, and I understand probably a 5 to 6 minute presentation given the timing today. So with that, Sam, if you want to take over, that'd be great.
Okay, thank you, Chris, and thank you, Keith, for those kind introductory remarks. And good morning, everyone. I'd like to first off reiterate what Chris said, and thank you for your long-standing support and for your consideration of our BIF5 fund. We're fundraising for BIF5 now, and we're going to be using the same strategy and approach that we've used on our previous 4 funds. I believe you have a presentation in front of you, and I'll refer to a couple of slides on that presentation. And I apologize if I get the numbering wrong, but on the far right side would be numbers that we have on our presentation, which start at 1 and go to about 17. And so just as a reminder, it is a global fund, and as was said previously, it's primarily investing in OECD countries in North America, Europe, and Asia Pacific, and we're targeting gross returns of about 13% plus, and average cash yields of about 5%. And we invest in core infrastructure assets from the transport, data, renewable power, utilities, and midstream sectors. Now, on slides 4 and 5, we have a couple of slides there that speaks to the scale of our organization. We are one of the largest infrastructure investors, with about 350 investment professionals dedicated directly to the strategy, located in 19 offices around the world. And our management team is the same that has been executing BIF4, and our senior leadership team has been with Brookfield on average for 15 to 20 years, and I've been with Brookfield for about 28 years. I'd like to make a few comments regarding slides 6 and 7. And on these slides, we detail the expertise and experience we have in all the infrastructure sectors and the various ways that we can drive value. We utilize our global reach, our access to capital, and our operating experience to source opportunities. These can come from carve-out of assets from larger entities, government auctions, and we sometimes take companies private from the stock market that do not trade at levels reflecting their intrinsic value. And all these approaches require experience and expertise that we have. Now, on slide 9, we show our track record across the previous funds, and it was described a bit earlier. I think it's notable that we generated consistent and strong returns that on a gross level average around 16% with cash yields of 6%. And we've been able to generate attractive cash yields because we utilize conservative capital structures. Now, on slide 11, we talked a bit about our investment strategy, and I would say that we have a very well-developed and consistent approach that we've honed over the decades. It comprises buying high-quality core infrastructure assets, investing on a value basis by leveraging the local presence and unique access to deal flow that I mentioned earlier, and then we seek to enhance the businesses by actively managing them to drive results. And on the slide, we describe a number of strategies we employ to create value in the portfolio companies. As an example, we have the ability to supplement returns on assets by leveraging our expertise in development and construction, particularly as it relates to transmission lines, renewable power facilities, and data centers. We also create platform companies where we execute a number of tuck-in acquisitions to create synergies and drive revenue growth. And in all cases, we're focused on de-risking our assets by employing conservative financing structures and enhancing contract profile. Now, on slide 15, I think it's important that I do address our efforts in ESG. We've had a strong ESG practice in place for a long time, and it's focused on the principles of protecting the environment and the safety of our people, as well as upholding strong governance practices. Our business is aligned with all the leading industry frameworks. ESG consideration is something that we've incorporated into all phases of what we describe as our investment life cycle. It starts first with the due diligence processes, where we do an intense evaluation of the ESG profile of a business, and then we identify areas for improvement. And then throughout the ownership of a business, we seek to employ best practices and we measure key KPIs, including carbon emissions and health and safety incidents. Each year, we publish an ESG report on our website that reports on our progress. And then the last slide I'd like to actually turn to is slide 17. And I thought I'd just conclude by describing why we believe the opportunity to invest in infrastructure is so strong. In fact, we've said for the last year or two that we think we are in an infrastructure super cycle. And I describe the trends in the following way. First off, global carbon reduction objectives are creating the need for huge investments into renewables, utilities, and transport sectors to meet the 2050 net zero target. On top of that, global data infrastructure investments will likely be in the trillions of dollars as the wireline and wireless infrastructure networks are being upgraded to meet the huge needs for data transmission storage. Typically, when we see this through many cycles, the transport sector requires huge investments to increase capacity and modernize the infrastructure to reduce bottlenecks. And then probably a more recent trend relates to global security issues, and this has been highlighted by the current conflict in Europe. And there's, as a result, a significant deglobalization trend that's basically underway, resulting in the reshoring of critical supply chains and industry, particularly in the data, semiconductor, and energy sectors. We expect this trend to accelerate, and this will result in hundreds of billions of dollars of required investment. So I'll conclude there. I'll just say that I want to thank you again for your consideration of BIF 5. We think the market opportunity for infrastructure investing has never been better, and we believe that our fund offers an established investment strategy and a proven track record. I'll pause there, and I'd be happy to take any questions from the council.
Are there any questions from the council or anything additional from either Keith or Seth? If there aren't, Nick, would you be willing to handle the voting and that part of the agenda so that my voice doesn't get overwhelming? Can you hear me?
Were you asking me?
Yeah, Nick, would you be willing to handle the motions?
Sure. Let me make sure I have that.
Yeah, get that page up. Appreciate it.
I had it here. Let me I'm trying to pull it again.
No problem. This would be on 3B.
3B. All right. I got it.
Okay. You can make that, if you can make that motion, please.
Oh, yeah. Well, I move that based on the recommendations of the Council Investment Committee consultant, the Townsend Group, SIC staff, and general fiduciary oversight of REK, I move that the State Investment Council approve a commitment of up to $100 million to Brookfield Infrastructure 5, subject to and contingent upon the Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thanks, Nick. Do I have a second?
It's Lee, I'll second.
All right, we got a second from Lee, motion by Nick. I just want to, if there's any further discussion, Nick was unable to join us for the council meeting, the investment committee meeting, due to a commitment conflict. But John and Mike and I, all three recommended this to the council unanimously. Is there any further discussion about this investment? Andy, would you please call the roll?
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Jennings.
He had to leave.
Okay. Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas?
Yes.
Ms. Allen?
Yes.
Mr. Bingaman?
Yes.
Chairman Lavender, the motion unanimously passes.
Thank you, Andy. Thank you, council members. Let's move to, and thank you, Brookfield, for being here with us today, and we look forward to more great success. Let's move.
Thank you, Mr. Chairman.
Thank you. You bet. Nice to have you here today. Let's move to vote the 3C. This will be BlackRock. Again, back to Keith and Seth.
Thank you, Mr. Chairman. We are recommending an investment commitment be made in the magnitude of $100 million to BlackRock Global Infrastructure Fund. This re-up would be SIC's third commitment to the fund series. Earlier funds carried the global energy and power infrastructure moniker and focused more narrowly on traditional energy and power assets. While the current fund's mandate is somewhat broader, the team's staffing, leadership, and access to key relationships remain substantially unchanged. BGIF will target net IRRs in the order of 10% with a high single digit current yield component. The team will apply a core plus value add strategy to assets supported by strong contractual revenues with opportunities for expansion through acquisitions, organic growth, or asset optimization. Select greenfield opportunities may also be considered. From an ESG perspective, BlackRock has made a 2050 net zero commitment and is an industry leader in incorporating environmental considerations into their investment disciplines. BlackRock additionally has committed that at least 20% of the fund's capital will be deployed in projects that will directly or indirectly advance the energy transition. Given the balance of benefits and risks, SIC staff and Townsend have recommended that we allocate $100 million to BGIF4. With that summary, I will hand off to Seth for his commentary.
Thanks, Keith, and I'll strive to be concise here again. So BlackRock, the Global Infrastructure Fund 4, it will be another follow-on commitment and a buy-rated fund here within Townsend. So we've committed to a total of $265 million to BlackRock's prior infrastructure and energy strategies, and this dates back to 2014. So this includes commitments to funds 2 and 3, as well as a dedicated co-investment vehicle within Fund 3. Our total exposure to BlackRock within the real return portfolio is 7%, and again, that includes if this investment is approved today, the pending $100 billion, again, and also well below the 30% policy limitation. Here, as mentioned, BlackRock is targeting $7.5 billion for a real asset fund focused on acquiring globally diversified portfolio of both core plus and value add infrastructure assets and asset-backed companies. Much like the conversation we just had on Brookfield, BlackRock is a very well-known sponsor and publicly traded. The fund will be managed by BlackRock's in-house global infrastructure team, really a unit of BlackRock infrastructure within the real assets group. This dedicated team came to BlackRock in 2017 through the acquisition of First Reserve, which is really where we actually originally invested with this team. For those that have been on the council since 2014, you may recognize the First Reserve name. The name of this BlackRock fund, the change, I guess, in the name to from the Global Energy and Power to the Global Infrastructure Fund is appropriately defined to more appropriately define the strategy. Which again, I'll let Brookfield really walk you through that. But I'd like to note that Fund 4 will be just more broadly diversified than prior funds. It'll include sectors outside of the traditional energy and power, as Keith mentioned, but also still capitalizing on many of the same themes and relationships that have been established by the team over the last decade. Again, here we highlight what we believe to be the team's and the fund's advantages. This includes really a deep, experienced, and specialized focused team, the BlackRock underlying brand, as well as a relatively conservative risk profile. The risks that we identify, again, are very well mitigated on materials, but include some of the early track record from Fund 1, which we actually don't have exposure to, but it's still part of the track record of the series. The expansion of the strategy as described, combined with a larger fund compared to the prior vehicle, Again, we're happy to elaborate on any of these, but we believe each other are very well mitigated and appropriate within the context of this commitment. So I'll stop here again and pass it over to the BlackRock team to walk through their presentation.
Great. So I should have made this introduction at the outset, so I do apologize for that. But joining us from BlackRock are Cindy McConaughey, an MD in the BlackRock Global Infrastructure Funds, and Mark Florian, who is Global Head of BlackRock Global Infrastructure Funds. So Cindy, if you'd like to go ahead, please.
Great. Thank you very much, Keith and Seth, and good morning, everybody. Thank you to the members of the council and Mr. Chairman for having us today and for the opportunity to present BlackRock Global Infrastructure Fund 4. We greatly appreciate your consideration and partnership in our previous funds, as well as investments across the BlackRock platform. I'm actually on slide 3. If those of you are able to see the BlackRock presentation, I want to get my page numbers right, so I'll just refer to the page numbers on the lower right-hand corner. Just to introduce the fund, Infra Fund 4 is a core plus infrastructure fund. It is BlackRock's flagship fund that will invest in essential, contracted, and diversified infrastructure assets globally. As noted, we follow a thematic investment approach, focusing on the long-term structural trends in the market. Our key investment theme is the global energy transition, which we are really seeing touch all infrastructure sectors at the moment. And we're really leading into that transition with what we call the 3 Ds: decarbonization, decentralization, and digitalization, which Mark will talk about in just a few minutes. A few things to note about the team and how we invest. First, our team, as Steve mentioned, led by Mark Florian, has been together for a very long time, over a decade, together in 3 prior vintages. Secondly, we carefully shape and structure our investments to create downside risk protection via fixed price, long-term contracted revenues that are also inflation linked with creditworthy counterparties. Which I understand was something was spoken about significantly this morning, so an important topic for consideration. Thirdly, we have delivered strong total returns since inception and are very focused on delivering consistent and attractive dividend yields early in our fund life cycle. From here, I'd love to pass it over to Mark Florian, who will take us through the market opportunity, team, and investment strategy. Mark, over to you.
Thanks so much, Sydney, and thank you to the council for your prior investments with us and your consideration of this investment as well. It's sincerely appreciated, the partnership that we've had. Sydney did a good job of talking about some of the key aspects of our funds. I'm just going to pick on a few pages in the presentation just to bring to life a little bit about our investment approach. So if you skip to page 5, the one that says investing in long-term structural trends, you heard about this a little bit earlier from some of other colleagues in the industry. But we think there are 3 things that are really driving structural change, which creates opportunity for investment. The first is decarbonization, which is obviously in many parts of the world striving to decarbonize our economies. And we think the interesting opportunity here today goes beyond wind and solar that have been the traditional ways of decarbonizing the power sector, to think about ways that we can lower emissions in manufacturing, agriculture, and transportation businesses. These are all investments that we would make that are long-term contracted, the right risk return profile. So we're not investing here to necessarily be clean. We're taking advantage of this long-term trend, find great investments for the portfolio. To be clear, we believe natural gas and oil are going to be with us for many, many years in the future and are critical for the economy. The second major trend is decentralization, and this is really the outsourcing of infrastructure by companies around the world. One quick example here is Dow Chemical. As you can see, the logos in the middle of the page. We acquired all of Dow Chemical's marine ports on the U.S. Gulf Coast. They decided they weren't the best owner. We came to them with a plan to show them we could run these ports more efficiently for them on their behalf and acquired them. That's an example of decentralization where a company's outsourcing infrastructure to save care of their hands, such as our funds. And also digitalization is a big trend. the interesting fact here is that the amount of data in the world is going up by about 30% a year. So it's doubling every 3 years. The other interesting aspect of this, obviously we need infrastructure to help support the use and storage and movement of all that data. But also a lot of the key companies that are involved in digitalization also want energy that is secure, available 24/7, relatively cheap and low carbon as well. So some of these trends actually interplay amongst themselves. As shown on the next page, we are a global franchise that's had substantial capital commitments as well as co-investment activities, and we obviously co-invested with you all, which has been a very good experience. I think it's performed well for you. And then on page 7, we do have a very experienced team, about 60 dedicated professionals inside of BlackRock. The managing directors and directors have about 20 years average industry experience. We have a great team located around the world, but we also leverage the broader BlackRock in terms of operational support, thinking about ESG, thinking about risk management, as well as for sourcing new investments. On page 8 is the series of funds that we've done over the years. You have been kind enough to be an investor in Fund 2 and Fund 3, both of which have and are continuing to perform above our targets. And you can see we are targeting a $7.5 billion fund. We think of ourselves as a middle market fund, a modest-sized fund that can find opportunities in a, we think, a very attractive range of size that they can help us create alpha. I did want to mention on page 9, there's a couple things we do to really work to generate alpha. The first is 80% of our investments have been done on a negotiated basis directly with the company around the world. That doesn't just happen. We have 900 companies around the world that we have targeted to have a conversation about outsourcing infrastructure or ways that we can help them with infrastructure that they need, that they own, or that they develop. And so that's generated 8% of our investments. We think that helps us create alpha, in part through comprehensive structuring. The average contract length for revenues in our third fund, your third fund, is about 14 years. And so when we get access, we negotiate strong terms, and that can provide for very stable revenues over time. And then about 80% of our investments are actually driven through control type style of investments. And so we're working with the management team on the board, or we are the whole board, driving value. So with that, giving time, I'll leave it there, but I think the key thing for us is that we want long-term contracted revenue streams, no commodity risk, or focus on dividend streams. And then finally, the portfolio is suited very well for an inflationary environment as we look at most of our energy contracts have inflation adjustment. So with that, I'll stop. Thank you very much for your time today and your consideration.
Anything further, Keith or Seth?
No, that's fine, Mr. Chairman.
No, I'm here.
Okay. All righty. Before Nick, I just, one quick aside, I think that I really appreciate both of these investments. I really like where we invest in real things. I also think if Stephanie were on the line, she would be impressed with the fact that each of these commitments have a pretty terrific amount of their going to renewable energy in the particular areas that are really critically important to New Mexico. So I think that's great. Nick, if you're willing to make a motion.
Yes, sir, Mr. Chair. Based on the recommendations of the Council Investment Committee, consultant, the Townsend Group, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $100 million to BlackRock Global Infrastructure, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thanks, Nick. Do I have a second?
I'll second.
Okay, Mike, thank you. It's been moved and seconded. Once again, three of us, John, Mike, and I, recommended this be brought to the council for approval. Andy, would you please call, is there any further discussion? Andy, would you please call the roll?
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
No.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Chairman Lavender, the motion unanimously passes.
Thank you very much, and thank you, BlackRock, and the folks from BlackRock for being with us today.
Mr. Chair, this is Chair.
Yes, excuse me. Go ahead.
Mr. Chair.
Yes.
Andy passed you, I thought I heard the Hudson vote.
I'm sorry.
You're correct. My apologies. The motion passes 7-1. Thank you.
Thank you very much. I may have jumped the gun on that. I apologize. Thank you for being with us today. And
Mr. Chair.
Yes.
One of the things, I like the way that Sandy actually states how many in paper and how many closed, instead of saying unanimously when it's to be on the 8 on paper. So we just continue that going forward, if that's okay with you. And thank you.
I'm sure.
Certainly.
Yeah, I'm sure we can do that, Andy. If you'll just do that in the future, that'd be great.
Will do. Thank you.
You betcha. Anything further? Well, once again, thank you, BlackRock, and good luck. And I'd like to remind everyone, please mute your phones if you're not speaking. There's some background noise that's coming along here. Okay, the next two matters on the agenda have to do with, they're more administrative. We're talking about the frequent contract renewal, and that would be Keith, if you want to speak about that, please.
Sure, Mr. Chairman, thank you. Frequent is arguably one of our most valuable third-party service providers. For those not aware, they provide us an ability to do performance monitoring, benchmarking, and investments. It's a great investment sourcing tool. Nino Carpenito has taken the lead on this key contract renewal conversation, and so I'm going to hand off to Nino to present the details.
Thank you. Nino? You may be on mute, Nino. We're not hearing you. Well, Nino.
Okay.
Calling Nino. Oh.
Okay.
Nino, so you want to just cover it for us, Keith? That'd be great.
Yeah, absolutely. So Frequent is a vendor that enables us to do performance monitoring and benchmarking of GPs that are in the portfolio, and also has proved very useful from a sourcing perspective. And so there have been a couple of investments that have wound up in the portfolio because we've been able to identify them within the Frequent database and to independently develop those relationships, and then to work collaboratively with the consultants to ultimately get those names into the portfolio. I think if you look at the value of, call it 100 basis points of alpha on $100 million potential commitment, you can see very quickly that the payoff from those new relationships can be very substantial and can cover contract expenses over a relatively short period of time. Frequent had come to us with a relatively significant price bump at the outset of the negotiations. It was, I guess I shouldn't say what exactly the number was, but it was quite large relative to what you see on page 239 of the board books. And Nino helped to lead this conversation
whereby we traded a longer contract maturity for significantly smaller hikes going out into future years. And again, you can see that we've targeted a 5-year contract renewal rather than taking the larger bump on a 1-year renewal basis. I guess I will pause there, and if there are particular questions, certainly feel free to ask.
Thank you, Keith. I think this is one of the critical tools we use to have the success that we've had. Are there any further questions or issues about this particular contract renewal? And by the way, good job on the negotiating the fees. If not, Nick, are you ready to bring this motion forward?
Sure thing. Based on the recommendations of the Council Investment Committee, SIC staff, and General Fiduciary Oversight, RBK, I move that the State Investment Council approves the selection of Maketa as fixed income.
Nick, step back one. You need, we're doing 3D.
3D, okay. Based on the recommendation of the Council Investment Committee, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve the renewal of Prekin contract, subject to and contingent upon the Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you. Is there a second?
I'll second. This is Lee.
Thank you, Lee. We've got a motion and a second. Any further discussion? All in favor? I'm sorry, we have to do it the old-fashioned way. Andy, now would you call the roll, please?
Yes, Chairman Lavender. Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Chairman Lavender, the motion passes 8-0.
Thank you very much, and thanks for doing as the treasurer asked. We'll move on now to 4C, or am I in the right place? I'm sorry, 4E. I think I'm having a hard time seeing the E. What I wanted to make clear to the council, as the council knows, our policy is to have a council member participate with any RFP. I was asked to do that this time, and I participated with the selection of this current selection of Makita. And we'll let, I think this is Vince, or this is actually, we'll let Vince lead us the way here. And I was extremely impressed. I actually had a meeting with them, was able to ask a lot of questions, and I'm very impressed. Vince?
Thanks, Mr. Chair. So, our stable of consultants is a very important component to the investment program. As you're very well aware, we have RBK, a general consulting role. We've got Mercer in our private equity role, Townsend in real estate and real return. And we've had Axia in our role of non-core fixed income. And actually, we hired Axia a number of years ago, initially to help us with the hedge fund portfolio, liquidating that portfolio and starting to move toward credit. And they did a great deal and a great job, a great deal of work and a great job in that move. And they've really helped us structure the non-core fixed income asset class, over the past couple of years. But there's been quite a change in the credit markets, the private credit markets. Many more of our peers have come in to that space, and in fact, we certainly were not leaders coming into the space. It was one that we needed to study and understand a great deal more before we moved in there. But we did begin moving in earnest, 15% allocations in land and severance, and many of the other funds. Tax stabilization reserve for childhood education, and a number of our clients are either in or interested in this area. It's been a big area of growth, not only for us, but the market in generally. So it made sense to us to survey the market for consulting, given the changes in the growth in this area. We had 5 excellent submissions for the work. All of them easily met our minimum qualifications. It was a very difficult decision to pare down to even 3 out of the 5. So the committee spent a lot of time doing that. And then we had many hours with each of the 3 on Zoom and over the phone, discussing their approach, what their approach would be to the mandate, what resources they had to bring to bear in terms of helping us manage that portfolio or manage that portion of the asset allocation. And then, of course, fees and costs that would be involved with getting their expertise on board. After intense discussions among the group, we did come to the conclusion that Makita is the firm we wanted to move forward with. Axia had an excellent submission, has done very good work for us as the incumbent. But Makita came out on top in this particular competition, and we're excited about the folks that will be joining us and joining the staff in developing these investments and bringing them forward and helping us manage that portfolio. So let me turn over to Tom. He's got a little bit more detail, and then he's going to introduce you to the lead consultant for Makita, and in turn she'll talk about the rest of the folks that will be involved and some of the things that Makita will be able to bring to bear for us in terms of consulting in this area.
Thanks, Vince. So I'm just going to highlight some things from the memo on pages 313 and 314. And then, as Vince said, I'll let Mary Bates from Makita introduce the Makita team. Makita demonstrated significant experience with private credit and with public institutions. I'd like to note that Mary Bates, who will be SIC's lead relationship manager, has significant direct experience in private credit, including time as Director of Credit Strategies at an alternatives manager. From my perspective, it's nice to have someone on our team that's been on both sides of the table. Makita communicated a thoughtful philosophy of portfolio construction and approach to onboarding new clients. Their supporting resources for manager and strategy research we felt were ample, and the process for manager and strategy due diligence was both thorough and detailed. As I mentioned, the primary relationship manager for the SIC will be Mary Bates. And Mary, with that, I'll let you introduce the Makita team.
Great. Thank you so much, Tom. And thank you to the investment council members. We are very honored to be recommended to serve as New Mexico State Investment Council's non-core fixed income consultants, and are excited to have the opportunity to provide a brief overview of Makita and our approach to private credit and non-core fixed income today. As mentioned, my name is Mary Bates, and I will be the lead consultant working closely with Investment Director Tom Lawson and the broader New Mexico team. I lead Makita's private credit practice and have been investing and advising clients on private credit since the global financial crisis, including the U.S. Treasury. I have over 20 years of investment experience across consulting, investment banking, and asset management, nearly all of that focused on credit. Like my teammates who will introduce themselves shortly, Tad Ferguson and Amy Sang, I'm a shareholder of Makita. Tad, Amy, and I are pleased to be joined today by John Haggerty, who leads our private markets team and is a member of Makita's Executive Management Committee. John will provide a brief overview of Makita, and then I'll share a bit more about Makita's approach to private credit and how we look forward to working with the Investment Council. But first, my teammates will introduce themselves. Amy?
Great. Thanks, Mary. Well, good morning, council members. As Mary mentioned, my name is Amy Xiang, and I will serve as one of the consultants on the SIC relationship. By way of background, I currently lead the Public Markets Manager Research Group at Makita, where I work closely with the equities, fixed income, and hedge fund teams in identifying, underwriting, and monitoring managers within these asset classes. I chair our Marketable Securities Investment Committee and am a voting member of Makita's Private Market Research Committee. Previously, I spent over 10 years at RBK, where I led the firm's fixed income and private credit research practice. During that time, I had the pleasure of working with Marsha, Matthias, and several of the SIC staff members. I'm looking forward to working with Tom and Vince again. Now I'm going to turn over to Tad to introduce himself.
Good morning. Tad Ferguson. I'm a private markets consultant with Makita Investment Group. I have over 25 years of industry experience, primarily working with large institutional investors in the implementation of private investment programs. And this experience spans the full spectrum of services, including investment policy development, strategic plan planning, portfolio construction, partnership selection and due diligence, and overall program monitoring. As Mary mentioned, I'm a shareholder of the firm, and I'm also a member of our Private Markets Research Committee, where we review and approve private credit opportunities on behalf of our clients. And again, I'd like to add my thank you for this opportunity, and I am really looking forward to working with all of you. With that, I will pass it along to John Haggerty.
Thank you, Ted. My name is John Haggerty, and I'll echo that appreciation for a thorough process and for this opportunity. I'm the Director of Private Markets at Makita and chair our Private Markets Investment Committee. I started at the firm in 1996, and I'm a member of the Board of Directors. As you may know, Makita has been consulting to institutions like yours for over 40 years, and we advise some of the largest public asset pools in the United States. We serve over 100 private market clients with a team of 50 private market professionals, and we pride ourselves on customized service and thought leadership. We believe that these two attributes are particularly important in private credit consulting, as the credit markets are highly varied and highly dynamic, as Vince alluded to. It's important that we understand your specific intentions as you make the allocation to the space. It's important that we help you tailor a portfolio that specifically corresponds to those intentions. And it's also very important in this dynamic space to monitor the industry and the markets to help revise a long-term plan for you. We're extremely honored to be recommended for this role, and I'll turn it back to Mary, who'll take a few minutes to discuss our approach to the credit markets.
Great, thank you, John. As referenced in our meeting materials, Makita's private credit team draws upon the broader resources of Makita's 235 professionals, including over 50 professionals dedicated to private markets. Makita views private credit as a broad, diverse opportunity set comprised of both income focus as well as capital appreciation strategies. Our approach to private credit is best defined by a few key tenets, one of which is private credit is credit, which to us means that downside protection is paramount, and we're very focused on loss mitigation and risk management. Our second tenet is that we believe in diversification across different exposures, corporate credit, asset-backed credit, mortgage credit, etc. We believe this diversification is one of the key benefits of private credit. Our third tenet in terms of implementation is we believe that it is important not to overcomplicate things. What this means most simply is often fewer managers with larger commitments. Finally, we believe that cost matters, and particularly going deeper than understanding the GP's management fee and incentive fee. In working with New Mexico State Investment Council, we understand that you have a well-established program with clear objectives. Our first role will be to act in accordance with those investment policies. We will work closely with New Mexico's staff to advise on sourcing and underwriting new investment opportunities. Furthermore, we will monitor and report on the existing program to the council and any other governing body as requested, and we will complete any other responsibilities as directed by New Mexico State Investment Council staff or council members. So on behalf of Makita, again, we are very honored to be recommended to serve as your non-core fixed income consultant, and we thank you again for this opportunity. That concludes my remarks. We're happy to address any questions.
Thank you, Mary. Any questions from the council? Hearing none, Andy, would you please call the roll? I'm sorry, gotta go. I'm a little bit out of sorts here. I'm in a different office and it's kind of got me a little bit off site here. Nick, would you please make the motion about on this?
Sure, 3E. I will make sure I get this one right here.
Okay.
Based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve the selection of Makita as fixed income consultant subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you, Nick. Do I have a second?
I'll second.
All right, Mike, thank you. We've had a motion and a second. Andy, any further discussion? Andy, would you please call the roll?
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rosson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Chairman Lavender, the motion passes 8-0.
Thank you very much. And Makita, welcome to the team. We're looking forward to a lot of great recommendations and close work with our staff. And welcome. Nice to have you aboard.
Thank you.
Thank you.
Let's move to the last part of this particular part of the agenda. Vince, if you want to talk about the Northern Trust software. Either that Brent, is that Brent or Vince? Brent, I'm sorry.
Yeah, that's Brent.
Okay.
Excuse me, Mr. Chair.
Yeah, Mike.
I'm in and out on my service, so I just wanted to get clarification about the date changes. If Andy would explain that to me, I would appreciate it. If you don't mind, Mr. Chair.
Are you talking about the investment committee meetings?
Yeah.
I think I'll be happy to just, what Andy had said was it gives them a couple more days to put the materials together for the council meeting. And the request is from the staff is that we move the investment committee meeting from the second Thursday to the second Tuesday, starting in October. September, we're already on the books to do it on the second Thursday, but starting in October, we would move to the second Tuesday. Nick, and John's okay. Are you okay with that, Mike?
Absolutely, that's fine.
Oh, okay.
Thank you for that clarification. Appreciate it.
You betcha. Let's see, Andy, we can talk about that. I don't believe that's a voting matter. We can simply make that change. Are there any further questions here about that? If not, Vince, if you want to talk about the software.
Actually, Mr. Chair, I think it's me. And before I do that, I didn't know if you wanted to, we had an audit committee meeting yesterday. I didn't know if you wanted Nick to maybe provide just a little bit of background on our meeting yesterday, or I can read however.
I apologize. I'm looking at the agenda in the wrong place.
That's okay.
Let's move to number 4 and Nick, the audit committee.
Okay, Mr. Chairman and council members. Yesterday we met in our committee with the audit committee. We met to discuss basically the entrance conference activities as our independent auditor, Bob Evans, is going to start that process on auditing fiscal year 22, ended June 30th of 2022. And had a real good meeting. We went over some of the required communications from the auditor, Moss Adams. And Senator Rossum brought up a really good topic of conversation where we talked about in quite depth related to cybersecurity auditing and that sort of thing. So we kind of fired at our auditor off questions that had to do with what they look at in terms of performing the audit and making sure that we have things and protocols in place to safeguard the SIC investment funds and accounts, because there are obviously so many and very, very large transactions and funds that the staff manages, and they do a great job of managing. And so we got in the weeds a bit, and I'm very comfortable with the measures that we have in place, the internal controls, the checks and balances on safeguarding sensitive SIC information. And so we covered a couple of different things that the staff oversees and implements, and that's related to making sure that the staff are trained up on what to look out for in terms of risks and, not falling into the traps of malware and things like that, making sure that IT equipment, servers, and those types of assets are up to date, current, and intact with current updates and safeguards there. And so we just had that conversation on that, and it was a really good meeting. And after that, we did talk a little bit about this Northern Trust investment that I think Brent will talk about.
Thanks a lot, Brent. Sorry about my out of step here a little bit. Brent.
Oh, no, that's fine, Mr. Chairman. I'm on page 327, and I'll be really brief. Just wanted to point out a couple of things on my talking points. Item number one, I have included the budget to actual schedule. I think it's on page 329 for the new fiscal year. You get one of these every month. As I always like to point out, this is 1 month into the fiscal year. So as we go further into the fiscal year and have more months of actual data in there, this schedule becomes a little bit more valuable. But I can tell you at this point in time, starting the fiscal year, ending the first month, I'm not anticipating any budget problems through the end of the fiscal year. And then secondly, as I always do, included the investment holdings report. I did want to also point out, because Steve provided some information on NAV values. I think he quoted a value of over $38 billion, which is definitely a high watermark. If you look at the summary page on the investment holdings report for July, you'll see that it's still in the $36 billion range. Just wanted to point out that the transfer that we got in for the early childhood education and care fund of $1.5 billion came in August. So it's not something that you will see on that July report. You'll see it in August. And I also wanted to point out in terms of that large transfer, that actually is for audit purposes going to be backdated into fiscal year 22. So that will be part of the audit. And then probably the most important thing that I'm doing here today is on page 374, and that's the appropriation request for fiscal year 24. As always, around this time of the year, point out we have 3 fiscal years kind of in motion right now. The fiscal year that we completed, fiscal year 22, we're going to be working on the audit that Nick talked about. Fiscal year 23, that's the fiscal year that we just started up. And fiscal year 24 is the appropriation request that we have due in September. Generally, for this appropriation request, we're not expecting but about a 2% increase over the prior fiscal year. Certainly, the pullback in the market in fiscal year 22, we had some values that have pulled back. Because of that, it put kind of downward pressure on the fees. So when we went in and actually did the estimating process for management fees, and that's the biggest part of our appropriation request, we didn't need to request any more than about 2%. I also want to point out for the fiscal year 24 information that you have in front of you, it is kind of tentative. We've waited, we've had some training with DFA as to some of the instructions and things that we're supposed to do. I think just yesterday we got the latest rate. So there's a few things on this that might change just a little bit between now and the time that we submit it in September, but it's probably not going to be more than $100,000. So certainly from a materiality point of view, you have everything here that you need. I have, as I always do, on page 377, I included kind of the one-page summary of the fee tester, or fee approximator, I should say. It helps me estimate the fees that we have for the fiscal year. I found generally over the last 7 to 8 years that I've used this, it's been fairly accurate. It certainly has provided estimates that allows us to make it through the fiscal year without a whole lot of adjustment. And then if there's any questions on that, I'm happy to take them now. If not, I'll continue on to the item related to Northern Trust.
Questions, yeah, if you can go ahead with that, that'd be great.
Sure. As everyone has been instructed in the past, we are working on a risk management project with BlackRock. It's called the ALAD project. One of the things that we've realized, after they've worked on this for a while, is because of the unitized pool accounting that we do for not only the many funds that we handle, but for the clients, it's a little bit more complicated than maybe BlackRock initially thought it was. We've got Northern Trust, who was prior Parallax involved, and I think we came up with a solution that will hopefully allow BlackRock to get the project through completion. But for that to happen, Northern Trust needs to do kind of a system project. It's going to cost about $75,000. We're going to do a proof of concept, some other information gathering, and then provide a daily file, which is going to, in addition to the $75,000, is going to require a maintenance fee of $25,000 annually. This is in addition to the normal work that Northern Trust does on the unitized accounting side. But I would just point out that the $75,000 is a one-time fee. The $25,000 will be recurring based upon the additional information that they are providing. And then, of course, the normal $66,000 that we're paying them right now. And that's all I had. Unless there's questions on that, it's pretty straightforward.
Thank you, Brent. Any questions about this particular matter? Nick, if you'd like to make the motion on behalf of the audit.
Okay. Based on the recommendation of the Council Audit Committee and SIC staff, I move that the SIC approve an amended contract with Northern Trust to provide investment accounting support as set forth in the meeting materials and discussed by the council today.
Thank you, Nick. Is there a second?
I'll second.
Thank you, Mike. We've got a motion and a second. No further discussion. Andy, if you'll call the roll.
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Mr. Lavender?
Yes.
Mr. Rawson?
Yes.
Mr. Messina?
Yes.
Mr. Taya?
Yes.
Ms. Allen?
Yes.
Mr. Bingaman?
Yes.
Chairman Lavender, the motion passes 8-0.
Thank you, Andy, and thank you, everyone. We're going to move on to item 5, closing matters. I think I'll have Steve, you brought this up in your opening remarks. If you want to take over and talk about this, please.
Yeah, this relates, Harold, to how the council would like to meet going forward. I think it's going to be helpful to hear from Brent, since he is ultimately responsible for our IT work. And Brent and I have met with Dave Jackson and staff to talk through whether we can have hybrid meetings, and if so, where they could be located. So Brent, if you would explain what we are thinking, please.
Sure, I'm happy to do that. As far as I understand, CIC is going to continue as it has been. There has been several people on the council that have suggested having meetings in person or in person. We've discussed that, and we've received feedback from a number of individuals, which I really appreciate. I think what we've decided, and hopefully this will be okay, we've decided, as Steve kind of alluded to potentially have a hybrid meeting going forward. Those meetings will be located in our office. For those people that want to be there in person, they can come and be at our office in person. We have all the technology, all the internet service that we need there. I think our IT staff can navigate that pretty well, given that it will be in our office. The real challenge is, and I'll point this out, having the meetings other places, you have to always deal with the other locations' technology, and that's not always as easy as that sounds. So we think probably the best solution right now is just to have a hybrid meeting at our office going forward. People want to come, they can come. If there's people that aren't comfortable being in the conference room, they can be in offices or other small rooms, whatever you want to do. But if you want to show up for a hybrid meeting, we're happy to do that. And that's what we discussed. And certainly it's open to discussion if other people have input.
Mr. Chair.
Yes.
Just, this is Nick. Going back to the question that the land commissioner had earlier on, how will the public be able to participate in this meeting, do you think?
Mr. Chair, if you'd like, I can take that. We're going to potentially, as I understand it, Nick and Steve can correct me if I'm wrong. In the past, when we've had meetings at the Capitol, public members were allowed in those meetings, and typically if they had any comments, they could make them toward the end of the meeting. I would envision, and I could be wrong, that it worked as kind of the same way. They'll be notified that the meetings are going to be at our office, and if they want to show up at our office, they're certainly invited to do that. And then once we get to the end of the meeting, the same type of procedure as we had before, they'll be allowed to, they have to notify Andy that they have a comment to make, and they'll be allowed to make that comment. And hopefully with the technology that we have there in the office, anybody that's going to be working remote will be able to hear what's going on and potentially interact as is needed.
Yeah, that's really important. We need to see if we can encourage the public to participate as much as they can in the meeting, especially in the public comment. Now the room is quite small, so that's just another thing to kind of consider. I know that we don't already have that many public members, but I think those are all valid points, Nick. I think probably the important thing to remember is I don't think everybody on the council, I would think a large part of them are still going to be, communicating remotely. There's going to probably be a few. If the room gets too crowded, certainly people that on the management team, if they need to, they can go into their office and dial in and be able to communicate. So I think we worked out a solution that will work for us, assuming that's the direction, or we continue the course that we're on right now until things kind of open up a little bit more. It's whatever the council desires.
Any further comments? I think my question would be, Steve, this isn't really a voting matter. I don't see it necessarily as a voting matter, but maybe it is. What would you like us to do to indicate our support of this?
Harold, I think if we could just have the consensus of those council members on the phone, that is all we need. We're trying to be respectful of the situation regarding the various types of COVID. We also want to be respectful of people who do not want to get together in person. And we want to make this work for everyone. So this is the best model that we've been able to come up with thus far. And we, as your staff, will do our best to make it work right.
Well, I appreciate that. I certainly, I think, as you know, I know Lee and I have both been pretty not adamant, but hopeful that we could get back to in-person meetings as quickly as possible. Actually, I'd love to see us get back into the Capitol, but I understand the difficulties with the logistics and all of those things there, the technology. So, did anyone on the council disagree with? Anyone want to voice a disagreement with this idea? Okay, well, you know what? The other thing too is nothing is etched in stone. So my idea would be, let's give it a shot. I think we could start with the investment committee meeting in September. Let that be the first as this. Yes.
I'm sorry, this is Lee, but it would be a lot better if we're going to do a hybrid that we at least have a Zoom.
I agree. I completely agree with you. I'll go back to Steve and to Brent. Are we talking about a Zoom situation?
Well, we can.
Go ahead, Steve.
No, please.
Yeah, it's my understanding, Senator Rawson, that we will have Zoom. The people that will be remote will be able to dial in. That's one of the reasons we want to have the office, because we have all the technology available there, and we think people are going to be able to communicate, remotely better than just a phone line. So, that's what we're anticipating. I do want to clarify. I thought, and maybe I'm wrong, I thought we were just talking the council meeting. I thought for the investment meeting, I thought it was going to continue as we've done it this past month, and that I think that was all remote. But certainly Steve can entertain discussion on that as well.
Yeah, I certainly would like to see that be the same. I'm sorry, Kathy.
I was just going to say, I think the hybrid solution is absolutely the right one, and it gives us the option of, and who knows how COVID's going to be almost month to month. So it gives us the option, if you feel comfortable, to come into the office. If not, to do it by Zoom. But I know I myself will need the address. I'm sure it's somewhere, but the address for the office to where to go, because I'll try to come in person in September. But I think it's a good solution.
Anyone else have an opinion? Okay, well, the other thing is, as I said, it's not etched in stone, so we can try it. So we'll do Zoom. The investment committee meeting will be Zoom, September the 8th. And then let's see, am I saying that incorrectly? No, that's right. September the 8th will be a Zoom meeting. And then the SIC meeting at the end of the month will be hybrid as well. And then starting in October, we'll be on the investment committee will be on the second Tuesday, and the council meeting will be hybrid. If we have difficulties or it becomes unwieldy, we can obviously change it. But I think that this will work. Steve, anything further on that matter?
We will do our best to make it work well for everyone.
October meeting, we're not changing the date of the council meeting. It's just the investment committee.
That's correct. The council meeting will continue to be on the fourth Tuesday, but the investment committee will move from the second Thursday to the second Tuesday. And
okay.
Lee has volunteered to serve on the investment committee. I think that we will have a conversation about that, but we'll bring that up at the next SIC meeting, and we can have more conversation about that. Moving to number 6, Charlie, has anyone commented?
Mr. Chairman, not today.
Not today, okay. And I think that one of the things that, Brenda, I'm not sure you meant it this way, but what you said, I think obviously public comment can come in through Zoom as well, I believe. As far as the logistics of how that might work as well. So we can add that to the conversation.
We will certainly work on that as to the best way to handle that.
Yeah, either that way or in person, either way. Does anyone? Sorry, yes, go ahead.
Sorry, this is Mike, and I just wanted you to know and everybody to know I'm going to be out of the country in November, and so I'll miss both the investment committee and the council meeting.
Okay, thanks. We'll make sure we take note of that.
Is Mike going to make sure he gets a chance to vote for the governor? You don't want to miss the election.
we get to vote early in Mora.
Oh, yeah.
All right.
I know it's a difficult joke these days, but vote early. In Chicago, the rule was vote early and vote often. But I think we've got to be careful about that. Does anyone have anything further? Steve or Vince?
Not for me, Mr. Chair. Nothing here, Harold.
Okay. Well, having covered this agenda pretty doggone thoroughly, I'm going to call this meeting adjourned. We'll see everybody in the investment committee in a couple of weeks, and everybody in a month. Thank you.
Bye.
Thank you, Harold.